We get the latest from Berlin. And eyes on these supplies. President Biden pledges $50 billion to help the chip industry amid a global semiconductor shortage. Let's take a look at the futures then, just 20 seconds or so to go until the start of the European equity trading session. You can see that the FTSE futures stand out for their weakness this morning. We saw this time yesterday that we had weakness in basic resources in the banking sector, and all of that played negatively, of course, for the sector exposure that we have here in London. So we'll see whether we get something similar today. DAX futures, CAC futures, all pointing a little more to the upside. Let's have a look at where these European equity markets open then this morning. And the FTSE 100 is just out of the gates and fairly flat at its first reading. We'll see if we get any moves to the downside, though. We are, of course, focused on the inflation story, the US inflation data. We'll get to that in just a moment. And we're kind of in limbo, maybe waiting for that to kick in, waiting to get the clues from that. And the retail sales data, as we heard from Mark, also due later on from the United States. So perhaps we're in limbo as we wait for that. US futures look to be in limbo. We have E-mini futures flat, Dow futures a little positive, NASDAQ futures a little negative. So a fairly mixed bag as we wait for that data to hit a little bit later on. MSCI Asia Pacific fairly flat actually through the Asian session. We had a little bit of deterioration towards the end as we saw a little bit of a move higher in US yields. But as I say, the big thing we're waiting for today is indeed around inflation. European equity markets opening then, as you can see, and we are actually a little more positive on the Stock 600 as a whole than maybe anticipated, up 0.1% as the CAC 40 helps to lift things. We also see the IBEX and the FTSE MIB opening in green. So it really is just a standout underperformance from the FTSE 100 this morning, which is down by just 0.1%, so just on the other side of that flat line from the CAC 40. So European equity markets opening fairly mixed then this morning, slight move to the upside. The upcoming US inflation data out later is in focus today. It's the first post-COVID CPI reading that is expected to exceed the Fed's target of 2%. Here's what officials are expecting.
This growth that we're expecting in the second half of this year is going to be very strong.
I think there will be more inflation in 2021 than what we've seen in recent years.
Headline inflation is going to likely move above 2%.
We know there's going to be a price surge this year.
I'm bullish on the rebound, but I know we have a long way to go.
We want to recenter inflation expectations at 2%.
We expect in our baseline most of that to be transitory and for inflation to return later this year to around 2%.
We want inflation to average 2% over time. And when we get that, that's when we'll raise interest rates.
Some important voices there from the Fed speaking about inflation and inflation expectations and what the reaction function will be. Paul Markham, Newton Investment Management Global Equities Portfolio Manager, is with us this morning to give us his thoughts. Paul, very good morning to you. So as we wait for this inflation data out of the US, we seem to be in a bit of a limbo here. What's in it for stocks, though, when it comes to this inflation print? I mean, thinking about the short or the medium term, if you like, if we get a very hot print on inflation, is that very negative for stocks? Is that what we're looking for?
Well, I think it's unlikely, Anna, that we get a really hot print to the extent that there has to be a significant change in central bank policy towards the potential of there being more inflation. However, it may be that the stocks do take a little bit of fright if inflation moves too fast, too quickly. We have already seen, of course, bond yields move up very rapidly from their lows from really the beginning of the fourth quarter of last year, or even maybe in August. But the stock market has really started to discount the idea of there being higher inflation. And if that starts to look as if it's not sort of slow, stealthy and controllable and actually quite positive for the more cyclical sides of the market, but it looks as if it's more of a kind of jolt upwards, I think that will probably be something which equity markets will have to step back and take probably as a little bit of a caution sign that they'll see interest rates rising more quickly. So I think we're unlikely to see that, but it's possible.
So, Paul, are you bracing for higher yields in the US and the knock-on impact that has for the trade-off between stocks and bonds? Because we were having a conversation in our last hour of the programme about, with inflation as high as it is, set to come in as high as it is, would it make sense for the 10-year yield, for example, to be much higher than it is right now? Now, we know that many things that we see in markets right now are anything but normal, Paul. But would you expect to see, are you bracing for higher yields?
Yes, we are. We would expect them to certainly try the 2% level on the 10-year. It could even go as high as 2.5% in a more extreme scenario. And that's something which I don't think is particularly out of kilter with market expectations. We do think that at the moment we have seen a bit of a plateau period for the 10-year, and we've also seen the potential for the dollar maybe to start consolidating a little bit. But going forward, we expect it to test those levels, and then from there, as one of the Fed officials said in the segment before, we may start to see it moderate again as the effects of the rebound start to wear off a little bit.
I was looking at some comments from one of my colleagues talking about signs of inflation springing up like spring flowers, Paul, which I mentioned yesterday, because it's a nice phrase. And I'm just looking now at a chart which shows me PPI numbers and some inflation measures coming from the PPI data, and thinking about where CPI goes, it tells us a very punchy story in terms of inflation. This makes me think about pricing power, though, and the types of companies that you might want to have exposure to that are going to be able to ride out this with their margins intact. Where do you look for those kind of businesses?
Well, actually, in a reflationary environment, and this is where the kind of circularity between bond yields, cyclicality, and inflation comes into play. In this kind of environment, it's actually those businesses which usually have less pricing power through the cycle, which benefit more from some recovery or cyclically driven inflation. And they would tend to be those kind of companies in the industrial space, in the commodity space, and the sort of value stocks, as they're loosely known, which can do best in that kind of environment. The stocks which are more secularly benefiting from some of the trends which we're seeing, for example, in IT, social media and so on, tend to be those which benefit from a lower inflation environment because they're gradually able to increase their pricing power as their business model unfolds. So it's really in those cyclical areas, Anna, which I think that the uptick in inflation may be most of a benefit.
Okay, interesting stuff. We'll return to the conversation shortly. Paul Markham, Newton Investment Management, Global Equities Portfolio Manager. He stays with us on the programme. Coming up on the programme, eyes on those supplies. Then President Biden pledges to address a worldwide semiconductor shortage in a White House meeting with CEOs. We'll get details next. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
United States Congress, we talk about whether or not we're doing anything in terms of bipartisanly. Well, we are. Both sides of the aisle are strongly supportive of what we're proposing, and where I think we can really get things done for the American people.
That was President Biden speaking about his plans to fix the chip shortage. Ed Ludlow has the latest from San Francisco after Biden proposed $50 billion for semiconductor manufacturing and research.
President Biden read from a letter signed by 23 senators and 42 House members backing his proposal to secure $50 billion specifically for the semiconductor industry. This was never going to be a landmark moment in the global chip shortage story. According to sources, it was more of an opportunity for the participants from the chip industry and their customers, those in the automotive industry and electronics industries, to air their grievances about the supply shortage. We know that the automotive participants in particular were hoping that the Biden administration would earmark some of that $50 billion specifically for vehicle-grade chips. But according to sources, the White House has no plans to treat or prioritize one industry over another. According to Intel CEO Pat Gelsinger in an interview with Bloomberg, that was the source of the debate within the virtual meeting, that there should be no special measure for one particular industry. It should be a solution that addresses the global supply shortage for all. And in many ways, the news was kind of overshadowed by industry news. NVIDIA, a main chip maker here in the US, announcing that it would enter the CPU market, a market that has been dominated by Intel for a long time. That caused a pretty sharp drop in Intel's shares and a pretty big gain in NVIDIA's shares, and was really the talking point in the industry on Monday. Ed Ludlow, Bloomberg News, San Francisco.
Let's pick up this conversation. Paul Markham, Newton Investment Management, Global Equities Portfolio Manager, is still with us. Paul, listening to that then, listening to what we've heard from the US administration, how they want to support the chip sector, this all part of a global rebalance perhaps being attempted by some in terms of supply chains around chips and a boost to the level of chip production that we're seeing globally. What investment opportunities are there in this view?
Well, I mean, the market has been a little bit concerned for the Asian manufacturers, which we've hitherto seen as being the most interesting plays on this chip shortage, because it worries that a lot of the sort of onshoring of chip manufacturing as opposed to chip design, so reopening of fabs, for example, on the part of some of the biggest US manufacturers, is negative for those Asian players. We would say that actually the pie as a whole is growing. And some of the best executors when it comes to making semiconductors do remain in Asia. So I think that the political crosswinds will concern markets here and there. And of course, some of the pricing dynamics will also change, because reshoring will mean that the cost base, the labor cost of making chips in the developed world are much higher. So that's going to sort of cause some competitive tensions and maybe some margin squeezes here and there for some of those players. But we would say on the whole that the demand for chips continues to rise very significantly. The pie is growing, and we think that most of the good operators in the space can still be good performers.
Now, car companies are big consumers of chips, Paul, and some of them, of course, as we know, had to pause operations, pause production because they couldn't get hold of the chips that they needed recently. So they'll be very keen to hear the details of this. But how much does this stand in the way of their pivot towards electric vehicles? I know you've been thinking about battery technology and see that as an important theme.
Yes, I mean, certainly on the chip side, the bigger manufacturers are really going to have to get well in advance as regards their new designs in order to incorporate these chips, which are often quite extensively tailored towards the individual models. And I'll have to make sure those designs are done with a good amount of lead time for the manufacturers. Of course, there may be some national champion-style behaviour starting to creep in here and there. We're hearing that some governments would like to encourage, via a variety of incentives, the manufacture of batteries in home countries. And let's not forget, this is a very fast-moving feast, Anna. You know, a couple of years ago, we were concerned about the flammability of batteries. Then we were worried about the range of them being only 100 miles or what have you. Now it can go up to 500-600 and going to 1,000. And then we're talking about solid-state batteries coming in as well, which will be another big step forward. So fast-moving technology, and I think that the big OEM car companies will want to be involved with those manufacturers which are able to give them the best access to new technology and R&D.
I have certainly experienced that range anxiety in the past. Paul, let's hope that changes. Let me talk about another sector, though, that I know that you're interested in, and that is financials. We started our last conversation talking about CPI and higher yields in the United States, and many people talk about financials as a nice hedge to that inflation story. Which part of the financials universe, though, do you want to have exposure to?
Well, from our point of view, tactically, it does appear that the banks could continue to do well. It seems likely that as we go into the end of this week and some of the bank names start to report, that there will be...
Good morning, everybody. Hope you're all okay. Right to the point. As you remember, just before the close yesterday, we opened short position on euro. And right now, overnight, it's moved down. So we need to place stop on profit. And I'm going to place stop on profit to 118.99.3. Okay, it will give us 10 pips in profit, and as you remember, as you can see, we sold short at 119.093. Okay, so if you follow this trade, if you decided yesterday to open position, short position on euro, you need to place stop on profit at 118.99.3. It will give you 10 pips in profit, and it's not bad. To be honest, overnight to get 10 pips. In our case, it will be £1,000 because we have £100 per pip. In your case, it's all about how much broker pays you per pip, how much money you invested in, right? I'll speak to you later. Stay safe.
In the second hour of the program, so I can do that. So that's the retail sales story in the United States cleared up. Let's get to some other breaking news and some news flow around a particular company that we're watching today. The Babcock share price here in London now up in today's session by 18%, 17.6%. Right now, you can see it's been up even further than that. A little bit earlier on was up as much as 34% at the start of the trading day. This after Babcock International announces it will write off £1.7 billion after it did an asset review. This is a reshaping of this British company around its aerospace and defence business. It's a company that makes warships. It does outsourcing work as well. And so we've got the results of this review, and the market's responding pretty positively to that. And the comments they made around their balance sheet as well. The company saying it intends to revive the balance sheet without raising new equity. And that could have been something that was pretty crucial to that share price move you're seeing this morning. Let's get an update on some of the other corporate news flow we're following this morning. Here's Laura Wright with a business flash.
Thanks, Anna. NVIDIA, famous for its graphics cards that power video gaming, plans to make its first microprocessors for servers. It's taking the fight to Intel, hoping to tap the firm's most lucrative market. Its new chips are based on technology from ARM, the UK firm it's trying to buy from SoftBank. NVIDIA says they will be available from the beginning of 2023. Jack Ma's Ant Group plans to drastically revamp its business. The firm is bowing to demand from Chinese authorities that want to rein in the country's fast-growing internet giants. Ant will now be supervised more like a bank. That has far-reaching implications for its growth and its delayed IPO plans. One of the biggest players in global commercial real estate says after the pandemic, some of the best locations in cities could fetch even higher prices. But JLL says getting there depends on the rollout of vaccines.
This is totally connected, the vaccination and going back to the office.
That's the Bloomberg Business Flash. Anna.
Thanks very much. Laura Wright. Here in London, coming up on the programme, after a rocky start, Europe's vaccination campaign is finally gathering pace. Up next, we'll hear more from our exclusive interview with Italy's Medicines Agency Director General Nicola Magrini about the country's vaccination efforts. This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Welcome back to the European market open. 21 minutes into our Tuesday trading session, and it's really just the FTSE 100 that is lagging behind the rest of Europe this morning, down 0.1%. Stock 600 up around 0.1%. Now, after a rocky start, Europe's vaccination campaign is gathering momentum. Germany has doubled its daily vaccinations. Meanwhile, Italy is looking to ramp up its campaign. We've been speaking to the Director General of the country's medicines agency.
Certainly, we can see clearly some light at the end of the tunnel, as we often say, and the increased capacity to vaccinate is a very good and promising sign. It has all very much depended on the quantity of vaccines available, and now the vaccines are much more than a month ago, and it will increase more in the next few weeks. So yes, the vaccination capacity has increased, and Europe is now more confident in getting out in the next months.
And do you believe this goal of herd immunity by September, do you still believe that's doable, and now even more so?
Yeah, we plan for it. I think the majority of the population, around 70% or 75%, will be reached by end of the summer. If we intend September, we can definitely reach that and have the summer months as the mass vaccination months.
And, you know, when you look at the countries in Europe, Germany last week had a very good week. The French, which were very slow, they had a good week last week too. The Spanish too. Italy, it does seem like it still needs a little bit more to get on that level. So when are we going to see the numbers really triple, like Mario Draghi promised they would?
We hope in the next 2 weeks to deploy more forces, including general practitioners, including local pharmacies and other vaccination sites that could make the expected 500,000 a day reachable.
So 500,000 a day by the end of April, that's doable in Italy.
We plan for it, or definitely by May, that should be the rhythm we should be able to have.
And, you know, you have Johnson & Johnson now coming into place. A single shot should make things easier. There's some concerns around it now over the blood clots. I mean, how excited are you about the vaccine, but do you see any problems related to the blood clots?
We see exactly the problem you had or didn't have in the United States. So we think that vaccine, much easier for administration, is the perfect vaccine for GPs in ambulatory setting, for individual patients, so that we'll be able to speed up the vaccination path, and it will very much depend on the quantities available that will make the difference.
You know, right now we see that in Europe is very much about the pace of infection more than the rate of vaccination. So when are we going to see that change? That the number of people vaccinated finally overtakes the number of people infected on a daily basis, so you can reopen up the economy?
The coming from a US source makes me in a dialogue mode toward the vaccine greed that some countries have shown, including the US, the UK, and Israel. I think we should have all been more united in a global effort rather than each country is thinking on its own on how to secure a vaccine without any sense of solidarity. So I think in the next few months, more vaccine will be available, will be distributed, and more people vaccinated. The only limitations we had was vaccine availability.
Bloomberg's Maria Taddeo there, speaking exclusively to the head of the Italian Medicines Agency, getting his views on the rollout and pace of it. Let's take a look at what is on the move this morning with your movers in the European equity market space this morning. Here's Danny.
Anna, Air France KLM shares down this morning, nearly 3.5%. New equity coming to the market. They're hoping to raise about 988 million euros. So with that increase in supply, we're seeing prices drop. A lot of the metal producers as well. That's another sector to keep your eye on. We had that China commodity import data that was very strong. So Norsk Hydro, for example, one of the biggest gainers on the stock 600, but also a lot of the copper producers, for example, like Antofagasta, also rising today too. Finally, the big gainer today, that's Babcock, the aerospace and defense company, gaining 15%, a review of their balance sheet that Jeffrey says is a positive for the company, simplifying things. Finally, let's take a look at the macro picture. All eyes on the 30-year yield ahead of the auction and inflation numbers. We're going to get those base effects, but still concerned considering bets for tightening had been pared back. Also, just wanted to put Bitcoin up here too, considering we have the Coinbase IPO tomorrow. Anna?
Very much, Danny Berger, with your stocks on the move and indeed some of the other macro themes in the markets this morning. Coming up here on the program, back to the German politics. Merkel's succession in disarray. Her bloc splits over the chancellorship nominee. We get the latest live from Berlin. That conversation next. This is Bloomberg.
Okay, guys, position is closed on euro. Overnight, no bet, not bad. We made £1,000. It's a good start. All of you guys, you probably received already confirmation from your broker how much profit you made. If you would like to get this strategy, you're welcome. You can get it from company.co.uk website. You can find it on our stream site on Red Line. Also, you can find it from the bonus from advertisement that we offer you 15 minutes free trading session if you want to. Well done, guys. Good. I'll speak to you later. Stay safe.
Let's take a look at how things are performing from a sector perspective then. We've got the London market underperforming, down by 0.1%. I can see that banks is one sector that is fairly flat this morning, which sometimes doesn't play to London's in London's favour. Technology is the biggest gaining sector this morning. Technology and chemicals, both of those sectors up by more than 0.75%. The biggest losing sectors, though, telecoms and healthcare. Fairly mixed bag then when it comes to the sector breakdown. The US futures pointing flat. In fact, flat this morning. E-mini futures are entirely flat. Nasdaq futures down by 0.1%. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. President Biden has told more than a dozen CEOs that he has bipartisan support for funding to address the worldwide chip shortage. The summit included the bosses of Alphabet, GM, Intel, and Ford. Biden read the firms a letter from lawmakers supporting his $50 billion proposal for chip manufacturing and research. The UK has hit its target of offering a first vaccine to all over 50s ahead of schedule. It's a boost to Prime Minister Boris Johnson's plans to unlock more of the economy. The health department says everyone over 50, as well as the vulnerable and healthcare workers, have now been offered a shot. The NHS is now letting over 45s book their vaccinations. President Biden is calling for calm in Minnesota after a police officer shot and killed a 20-year-old black man during a traffic stop on Sunday. It sparked a new round of violent protests over the excessive use of police force. It comes as Derek Chauvin, a white police officer charged in last year's killing of George Floyd, stands trial in nearby Minneapolis. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you very much. Laura Wright here in London. Now to Germany. Chancellor Angela Merkel's succession looks to be in disarray. The parties in her Conservative alliance are split on who should be the candidate for the top job. Bavaria's CSU has backed its chairman, Markus Söder, snubbing its largest sister party, the CDU, which is supporting its leader, Armin Laschet. The joint candidates almost always comes from the CDU. Let's get some analysis then now. Suda David Wilp, German Marshall Fund Deputy Director of the Berlin office, joins us now. Suda, very good to have your insights then on this matter on the programme. Good morning. Let me ask you, I mean, who do you think stands the better chance, if we start with that perspective, better chance of being Chancellor or maintaining the Chancellorship for the centre-right? I mean, Söder does poll very well, but Bavaria doesn't typically offer up a winning candidate on this front. So what is your thinking on this?
That's right, Anna. I mean, usually the role, it's customary for the CDU chancellor candidate to go to the chairman, and that is Armin Laschet, the minister-president of North Rhine-Westphalia, which is the most populous state in Germany. He has the backing of the leadership of the party, the so-called presidium, but he is not polling strong compared to Markus Söder, the minister-president of Bavaria, from the conservative sister party, the CSU, the smaller sister party in Bavaria. And that is the conundrum that the CDU faces. Most likely, they'll go with the traditional decision because there actually has been no precedent. There never has been a chancellor from the CSU in Bavaria. There have been two shots at it before, one with Edmund Stoiber, who lost against Gerhard Schröder in 2002. And then, of course, when in West Germany, Strauss tried to take a shot at the chancellorship. So it would be a risk to go with Markus Söder, but the CDU is really looking at a downward trajectory in the polls, and that's the question. Should they go with the traditional choice, or should they go with Markus Söder, who at the moment is polling highly?
How does all of this play more broadly for the Conservative bloc then, in terms of polling, Suda, and you've hinted at it just there? How does this play at a time when Germany is still very much at the forefront of dealing with the coronavirus pandemic, to see this, what could look to some as infighting within the Conservative part of German politics?
So the political brinkmanship within this Conservative bloc is really not a good look, because there is a raging pandemic in Germany, and the Conservatives are really taking the heat for not being able to control the pandemic. At the outset, they were riding very high with favorability ratings at an all-time high for Chancellor Merkel because of her unique mix of scientific expertise and also her ability for crisis management and also to communicate with the German electorate. But since then, the picture has changed because of the slow vaccination rollout, the lack of testing, and even just the inability to have political consensus of how to mitigate the spread of COVID here in Germany. And, you know, they're looking at furthering lockdown measures. So the CDU is not in a good place right now. And to have this internal fighting is not helpful 5 months before the election. And also recently there have been some procurement scandals within the CDU. So suddenly, you know, the CDU is not taking for granted the chancellery, because everybody thought just a few months ago that the CDU would coast again to take the chancellery come September.
I think you already mentioned 1998, Suda, but maybe I could just ask you how much you think that there could be parallels with 1998. The CDU's Kohl, of course, lost to Gerhard Schroeder of the Social Democrats in that year. And just like now, in that year, the CDU had been in power for some 16 years. Are people making a lot of that kind of comparison?
Well, the interesting thing, Anna, is that, as I mentioned before, you know, Merkel was very popular at the outset of the pandemic and still arguably is. So I think her legacy, no matter what, is somewhat intact. But if we look at the CDU and how it was faring before the pandemic, the party was in a downward trajectory even back then because they were, you know, they did very poorly in state elections and in the EU elections. And that was one of the reasons that Merkel decided to step back and not run again. Due to Merkel fatigue, and just like the sort of the fate of major parties all over Europe, even the center-left party, the SPD here, these parties are losing their allure, and these catch-all parties like the CDU are losing out to rivals such as the Greens.
So that's the sort of build-up to the election coming later on this year. In the more immediate future, Suda, I wonder how much the build-up of troops on the Ukraine-Russia border, or the Russian troops on that border with Ukraine, how much of that is getting into the German narrative? Clearly, this was something back in 2014 that Merkel was very involved with dealing with. How much is this being talked about in Germany at this point?
I mean, it's definitely in the headlines, but of course, the political intrigue about what's going on within the Conservative Party is dominating the news right now. But the fact that Secretary Blinken will be coming to Brussels again, and in fact, today, I believe that Secretary Austin from the Pentagon will be meeting with German Defense Minister Annegret Kramp-Karrenbauer, is also going to be on the agenda for Germany. Certainly this visit to Brussels is to, show concern from NATO about the buildup of forces in Ukraine, but also to talk about other relevant topics, such as winding down the presence in Afghanistan, the troop presence, and also working to curb Iran's nuclear ambitions.
Suda, thanks very much for your time. Good to speak to you. Suda David Wilp, German Marshall Fund Deputy Director, Berlin office, giving us her take on the German political scene right now. Coming up on the program, new rules for Wall Street's hottest trend. We discuss the changes in store for the SPAC boom. Could we see an accounting threat to the SPAC wave that we've seen taking Wall Street by storm? More on that with Danny next. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday.
We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Welcome back to the European Market Open. 41 minutes into Tuesday's trading session. The London market's a little bit of a laggard this morning, down by 0.1%, broadly making some modest gains on European equity markets. Now, two of the world's most powerful money managers are joining forces to create a climate-focused venture capital fund. BlackRock and Temasek's new firm, Decarbonization Partners, will back startups developing technology to reduce fossil fuel reliance. The pair are committing $600 million, but aim to eventually manage billions. BlackRock's CEO Larry Fink and Temasek's CEO Dylan Pillay spoke exclusively to Bloomberg about the plan.
To properly address the whole issue of decarbonization, we're going to have to develop new technologies. We don't have many of the new technologies today, or we have the technologies, but those processes, whether it's cement, green cement, or green hydrogen, or so many other things that emit carbon, the cost to do it green is very expensive. And to truly get to a net zero world, it's way beyond electric vehicles, solar and wind. Let's face it, hydrocarbons are very cheap. Hydrocarbons are cheaper than a bottle of water.
Dilhan, a few nuts and bolts questions, if you don't mind, so people have a sense of, call it, scale. What are each of the two partners bringing to the table here? Will the joint venture have its own staff? How many people will be involved? That kind of thing.
We're now focusing our investment activities across a broad range of sectors where we think we can make a difference and where they too can make a difference to reducing carbon emissions, especially as we aim for net zero world in 2050. Now, BlackRock has incredible strengths to bring to this joint venture. They have a very strong data analytics model as embedded within their Aladdin system. They have the ability to source the like-minded investors to join with us in this foray. But they also have access to many companies which are able to not just bring solutions that we think are needed, but also companies that could be test bedding these solutions.
Dilhan, tell me, what does success look like for this this venture? Are there, call it, KPIs? Is there a targeted return? And a key question I'll add to that, are you willing to accept a lower return or take on more risk in order to increase the impact on carbon reduction?
I think the first objective that we seek and for which success should be determined by is the evolution of innovative solutions in the decarbonization process, or what I would call the carbon abatement process. And if these solutions can bring down the carbon abatement cost curve such that we will see commercialization and implementation, I think that's the first sign of success for this joint venture. And tied to that, of course, is the need for financial returns. In order for this to have a journey where it can go on for a significant period of time, we have to be disciplined in how we make these investments and to be focused on getting the right returns so that we can crowd in more capital into this space and encourage others to do likewise as we are choosing to do in this joint venture. So I would say that we are not going to look at sacrificing returns in this area. We believe that at the end of the day, the returns will come. We may have to wait for a longer period given the early stage element of this partnership, but we do believe that the returns will come, as we've seen in other sectors that we've invested in at an early stage.
And can we put a number on that targeted return?
Well, we have a targeted return in line with most early stage funds, which is about 20% IRR. And so we're seeking to get that over a reasonable period of time.
Larry, part of the plan here is to raise money from other investors. And if you're successful in that endeavor, how big do you think this could get in terms of AUM?
I would say the first pool of money should be no larger than $5 billion. We're going to be testing this. We're going to be building it. We have proof of concept, and then we'll see. And a $5 billion early stage, late stage fund is a large pool of money. So some of the investments are going to be quite small, and some of the investments will be much larger. This is not tens of billions of dollars. It may lead to those type of large scale investments, but it does not need to be that large scale in the early beginnings of this venture.
BlackRock CEO Larry Fink and Temasek CEO Dilhan Pillay speaking exclusively to Bloomberg's Eric Schatzker. Interesting conversation then around early investments in new technology on the green agenda. Now, the SEC is cracking down on SPACs and their accounting rules. Regulators are changing the guidance for warrants, which are an option to buy shares at a specific price in the future. The move threatens to disrupt new filings in a red-hot market. Joining us now with the latest then is Danny Berger. Danny, what impact then are these changes going to have? This is an accounting story to watch, isn't it?
Yeah, and I mean, usually accounting stories, they sound like kind of a snooze. I mean, it's a wonky thing, warrants on their own. But look, warrants themselves are really an important part of raising money for SPACs. They're given to early investors. They're an incentive because it means that they can have higher profits by cashing in these options in the future. Basically, what's going to change is usually warrants live on the balance sheet of companies as equities. The SEC is saying that in certain circumstances, they should be liabilities. So what does that mean? Well, if it's a liability, that means you now need to account for changes in the value of that warrant. And if the value changes enough, it means that companies have to reinstate their financial statements. I mean, you can imagine how much of a headache this would be for accountants and lawyers if these warrants and values are all of a sudden changing and you have to redo all this work you've already done. So that in itself is going to be problematic for a lot more of these SPACs that go on to acquire a company. But in the meantime, Bloomberg did see a letter from a top accounting firm that said as the SEC is figuring this out, they're not really taking on new approvals for SPACs. So this could also mean the pipeline at the moment, which is hundreds of potential blank check companies, could be put on ice while the details are hammered out.
And this matters, Danny, doesn't it? Because SPACs have gone from being something pretty niche to being mainstream, essentially, on Wall Street.
Yeah, I mean, if you look at all the new listings, 3/4 of them are SPACs in the U.S. It's not IPOs anymore as the preferred way to go public. And, this is just one thing. This is just accounting rules. But you have to ask, is this just the beginning? Is the SEC going to take scrutiny on different parts of SPACs? Last week, the SEC did hint that they would look at SPACs much like they look at IPOs. So they wouldn't get any special regulatory treatment. I mean, they've even gone so far as earlier in the year to warn don't buy a SPAC just because it's endorsed by celebrities. So I think there is a sense that because this is becoming so dominant, the SEC has to make sure that everybody is playing by the rules and that those rules are fair, Anna.
Okay, Danny, thanks very much. I'm sure they'll get a lot of scrutiny, won't they? Danny Berger with the latest on SPACs and the potential for an accounting threat that could see something becoming a liability, changing the maths behind some of those SPAC decisions. Now, coming up on the programme, buckle up for inflation with bond volatility thrown in. This is the view of our MLive macro strategist, Laura Cooper. We look ahead to the US data release later today. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European market open. 52 minutes into our trading session, let's put it that way. And we've got, I was going to say it's 8 minutes to 9 here in London. And this is the picture for you. Modest gains across European equity markets. The London market underperforms. We are waiting for inflation data out of the US. That's the big news anticipated for the day. Let's talk to Laura Cooper, Bloomberg Markets Live macro strategist, who joins me here on set in London. Laura, good morning. So inflation data due later on. There's been so much said about this inflation print, how high it's going to be. I suppose what also matters is how long it remains at elevated levels. But what are we expecting then in the more immediate future?
Well, we are expecting that headline price print to come in quite high at that 0.5% month on month. And that reflects the fact that we did have headline prices fall a year ago owing to those base effects, those declines in energy prices. But we are seeing signs of price pressures in terms of rising energy prices, in terms of rising food prices. And we also have those supply side disruptions feeding through. So I think markets, if we do see an upside surprise today, I would expect that to spark some bond volatility. We have seen rate hikes being slightly priced out over the past month from the Fed. And as well, when we look at stocks 500 equity futures are likely to come under pressure as well, because markets really don't know how to read this inflation. We won't get any confirmed signs for months to come.
Yeah, it's interesting when you listen to those from the Fed saying, they don't mind inflation above 2% for a while. And it's that kind of definition around for a while. Yes, they want to average it at 2%, as we heard over the weekend from Jay Powell Powell. It's interesting to think about then when we start those tapering conversations with the Fed, and we got some clues around that from James Bullard, didn't we? Kind of explicitly tying this to vaccination rates. And that put me in mind actually of something you wrote last week, which was about hesitancy rates in different countries around the world. And I thought, well, that if central banks are really going to be looking at the take-up of vaccines and tying that to taper, then we really need to pay attention to this.
And I thought the comments from Bullard were so incredibly interesting because right now we don't have a lot of clarity in terms of what their outcome-based forward guidance is. So, you know, is it based on unemployment? Is it based on inflation? They're not giving a clue of that because, yes, they want to let the economy run hot. They want to have inflation above 2%. So the fact that we are starting to see signs that potentially by late this summer we could see tapering hints creep in, I think that's quite notable for markets. And as well, I don't think that markets are really pricing that in yet. We had the Bank of America fund manager survey, and that came out saying that bond market taper tantrum is now the top tail risk for investors. And that overcomes inflation, which was the top tail risk last month. So even though inflation is still quite high in that radar, most anticipate it to be quite higher over the next 12 months, it's surprising to see that taper tantrum risks are emerging back to the surface.
Yeah, we certainly talked about that a lot at the start of this year, didn't we? We saw US 10-year yields rise. It wasn't a taper tantrum, something of a smaller scale perhaps, but certainly a reminder of just what the link can be between, you know, the US 10-year yield and stocks. So we'll continue to watch that. The UK economy, we got some GDP numbers a little earlier. I see the take from Bloomberg Economics. GDP recovery takes baby steps, big leaps ahead. And that is, you know, it's kind of a bit backward looking, I suppose, even already, the February number. Everybody's focused on the reopening story today.
And it's all about the reopening story. I mean, just looking at the lineups outside of UK shops yesterday, it's going to potentially be a sharp rebound for the UK economy. Again, we won't really know the extent of that rebound and whether consumers in the UK will unleash that pent-up demand that we've been kind of in lockdown for the past year. But certainly, I think when we look at what's priced into markets, I would say that a lot of that recovery optimism is already baked in. Sterling is struggling for upside against the dollar and against the euro, and the FTSE 100 is struggling. So it's going to be quite interesting to see how markets fare.
Yeah, we will see, for those who have those savings after the lockdowns, what percentage of that is spent. That's going to be a really important factor, isn't it? Laura, thank you so much for joining us. Laura Cooper, Bloomberg Markets Live macro strategist. That is it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
we're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
These wafers are batteries, broadband, it's all infrastructure. This is infrastructure.
We want to recenter inflation expectations at 2%. This is an ideal time to do that.
The change in policy is well motivated. The risk is that the Fed will be late.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 13th of April. I'm Yusuf Gameneddin in Dubai, covering for Francine Lacroix. And here's what's coming up on today's program. Stocks and futures pip higher in anticipation of today's U.S. inflation data. The St. Louis Fed President James Bullard, he's weighed in and he tells Bloomberg that getting 3/4 of Americans vaccinated would allow for a tapered debate. Söder's seeds of doubt. Angela Merkel's succession plans are in disarray as the CDU-CSU bloc splits over their nominee for Germany's chancellorship. Plus, Biden backs chips. The U.S. president pledges $50 billion to help the industry amid a global shortage. NVIDIA unveils a new range of processors in the meantime to chip away at Intel's most lucrative market. Well, and 75% of U.S. vaccinations, that's what James Bullard thinks will signal the end of the COVID-19 crisis. The St. Louis Fed president says that getting 3/4 of Americans vaccinated will be a necessary condition for the central bank to consider tapering. But he told Bloomberg that it might be too soon to talk about that as it stands.
I think it's too early to talk about changing monetary policy. We want to stay with our very easy monetary policy while we're still in the pandemic tunnel. If we get to the end of the tunnel, then I think it'll be time to start assessing where we want to go next.
So the critical question is then, can we see a taper talk as early as August? About 36% of Americans have been given a first vaccine dose and 22% have been fully vaccinated. Danny Berger is joining us for more on this. Danny, what moves are we seeing in the markets after a couple of days of waning momentum in the broader reflation trade?
Yusuf, I still feel like it's eerily quiet in markets. I mean, we don't really have any huge moves. Look at S&P futures up just 4 basis points, basically flat at this moment. So not a lot of volume, not a lot of volatility. Now, we are seeing yields chart ever so slightly higher. The 30-year yield is, of course, one to watch ahead of today's auction. But we just have this absolute data deluge. So perhaps it makes sense that right at the moment, there aren't any big moves, any big positions putting onto the market between CPI, we have earnings, we have retail data. All of that could possibly disrupt the market. But one thing to keep in mind is that when it comes to bond market volatility, it hasn't really picked up quite yet. This is the Merrill Lynch Move Index. And you can see it started to move higher as we got that pickup in yields, basically has been flat because a lot of the inflation story, we're not going to truly know until the summer. As you say, Yusuf, those virus counts and the vaccination might change the picture, as well as we need to get rid of those base effects. We know the CPI numbers are going to be large because of that. Now, just in case the total entirety of the day is just inflation talk, Yusuf, I did want to bring you just one other market story, and that's Bitcoin at the moment trading at a record high. If it's able to end the day at this price above $61,000, we get the Coinbase IPO tomorrow. For the first time, really seeing one of the big merges of traditional finance avenues and crypto finance avenues.
Danny, thank you very much for the moment. That is Danny Berger there. Let's get out to John Norman. He's the JP Morgan head of cross-asset fundamental strategy. John, as we count down to the CPI data and taking into consideration what we just heard from some of these Fed officials, what's your read then on a potentially earlier than expected taper?
Well, I don't think they're going to be starting that discussion until the summer because they need to see what the inflation numbers are going to look like. They need to see how the economic reopening affects a lot of the macro data, and they really need to see how the virus evolves. So I think they're still pretty much sticking to the party line that it's too early to really talk about tapering. That doesn't mean you still can't see a move up in bond yields. Keep in mind that the bond yields are still strangely low for an economy that's going to be delivering 8% growth, and they're still too low for an economy that's going to be delivering inflation expectations somewhere closer to 2.4, 2.5%. You still get movement in the bond market. I just don't think it's going to be very dramatic in Q2.
So what kind of moves then are you expecting in terms of U.S. 10-year yields? Because you talk about front-end repricing, you talk about the bond bear coming back into play. Just give us a bit more substance to that.
Sure. I think if you saw 25 or 30 basis points higher in 10-year rates in Q2, that would be pretty much the extent of the move. Because as you mentioned, the front end is already pretty aggressively priced. The first Fed hike is discounted for the first part of 2023. That's pretty aggressive. That basically means that the U.S. is going to make substantial further progress on the inflation goals by the end of 21. The Fed is going to spend 2022 tapering, and there's going to be very little pause, if no pause at all, between the end of the tapering and the start of the tightening. That's pretty punchy. That's why I think the only scope really to push bond yields higher in intermediates in 10-year rates is a move up in inflation expectations. That to me could be 25, 30 basis points. That's where I kind of put the cap on yields in the next quarter. So, and if that's all you might get in the next 3 months, that shouldn't be disruptive at all for financial markets broadly. Maybe for a few EMs that have some big imbalances and some difficulty stemming COVID, but I don't think this is going to be an issue for credit markets or equity markets.
So the Markets Live team has been crunching some numbers, and they've been looking at historical data around which assets tend to benefit from inflation. It's an age-old question, but you have done some work as well on your end, and that ties specifically to alternative assets. Which ones stand to benefit the most out of a CPI around 2.5% as expected on Tuesday?
Well, I don't think that it's really an issue of what the CPI does over the very near term. I think the whole idea of inflation hedging is that as the cycle evolves, the longer growth stays above trend, the more inflation is going to rise on kind of a multi-year basis. So you basically want to be owning assets that are relatively scarce, and commodities are relatively scarce when you think about what's happening with inventory conditions in some of the key ones. Some of the private assets related to commodities like natural resources are also in fixed supply. Infrastructure is sort of a fixed supply asset too. So these are the ones both on the private side and the public side that investors should be looking at over the next few years. I'm not envisioning that these are going to have big moves over the next quarter or so. That's not really the hedge horizon people need to be thinking about. The horizon they need to be thinking about is the next several years, what's going to be the path of core inflation once the U.S. is at full employment. And that's why I think it's basically about commodities in the public markets, some of the resource stocks within the equity markets, and then I think it's pretty much infrastructure and natural resources in the private space.
John, I look at some of the rate high expectations from the bond markets and compare that to what you conclude from some of the Fed projections. There's a very clear disparity, end 2022 versus end 2023. Where do you stand?
Well, I don't have a clear view on when the Fed is going to achieve the inflation overshoot. I think you can have the Fed delivering exactly what it wants in terms of full employment, meaning getting there by 2022, but that has never in the past 30 years been a guarantee that inflation moves meaningfully higher. So anyone who says they have a lot of confidence that inflation is going to be moving up above 2% on a core basis, I'd say there's next to no history that can really inform that. It's kind of a guesstimate. What I can tell you is that relative to what's priced into the market, there doesn't seem to be much of a risk premium for the possibility that the Fed is going to get the inflation overshoot. So when you look at inflation break-evens and you adjust for the fact that those break-evens are priced off headline, not the core measure that the Fed targets, it looks like the market is pricing in core of around 2%, so no inflation overshoot at all. And this, to me, is really the crux of the argument around why you need to own some inflation protection. Even if you don't think that it's guaranteed to happen, there doesn't seem to be much of a risk premium in the markets for Fed success, and that's why you have to own break-evens. That's why you have to own some commodities. That's why you have to own some resource stocks.
John, hold that thought. We still have a lot to cut through. That is John Norman of JP Morgan. He stays with the program. Some breaking lines. Hey, the Bloomberg red-hot headline, in fact, from a developing story over the last few hours from an asset management company, Huarong, in China, and that has been put on review for a downgrade by Moody's. That line just hitting the Bloomberg. This comes off the back of what is a growing panic over the financial health of what is one of China's largest bad debt managers. That's kind of spilled into broader markets. And what we've seen is a sell-off that spread to other high-yield Chinese dollar notes, with some property bonds falling by a record. We're going to get into more details of this story later on in the program. But again, to reiterate, Huarong AMC ratings have now been put on review for a downgrade by Moody's. Let's get you a bit of a snapshot then of what else is coming up. We're talking about China's imports as well, because they jumped 38% in dollar terms from a year ago. But exports gained less than expected. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also, we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Yusuf Gameldine in Dubai. Let's get to you the first word news again with Leanne Garrett. Leanne.
Good morning, Yusuf. In Germany, Chancellor Angela Merkel's succession looks to be in disarray. The parties in a conservative alliance are split on who should be candidate for the top job. Bavaria's CSU has backed its chairman Markus Söder, snubbing its larger sister party, the CDU, which is supporting its leader Armin Laschet. The joint candidate almost always comes from the CDU. Now, Japan plans to release more than 1 million cubic meters of treated radioactive water from the wrecked Fukushima nuclear power plant. It won't start for about 2 years, and the US says the move is in line with global standards. But Japan's neighbors are critical, with South Korea expressing grave concern. And President Biden is calling for calm in Minnesota after a police officer shot and killed a 20-year-old black man during a traffic stop on Sunday. It sparked a new round of violent protests over the excessive use of police force. It comes as Derek Chauvin, a white police officer charged in last year's killing of George Floyd, stands trial in nearby Minneapolis. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Youssef.
Thank you very much for that. Trade in China surged in March, a sign that the global recovery from COVID-19 is on track. A whopping 30.6% increase in exports still came in under estimates. Later this week, we'll also get an update on GDP, with Bloomberg Economics predicting a record growth of 20.1% year-on-year in the first quarter. John Normand of JP Morgan is still with the program. John, as you had a chance to reflect on some of these numbers, net positive for bonds or equities in China?
Well, I think what's going on in China is a pretty remarkable disconnect versus what's going on in the developed world, meaning even though you're going to have a monster number in terms of growth in Q1 year on year, the quarter-on-quarter message is going to be about deceleration, and that deceleration could continue throughout all of 2021. So you can have a China slowing down while the DMs are picking up. The obvious difference is the fiscal policy setting between these two parts of the world. But, I think that has some important implications. It makes it really tough to be broadly bullish on EM or broadly bullish or as bullish on commodities as you might normally be in a global growth upturn, simply because the Chinese growth momentum is going in the opposite direction of the rest of the world.
I mean, you stay underweight on some of these emerging market, local market duration plays. Does that apply to China as well, or would you say that actually the fixed income space, despite some of the shockwaves coming through from this asset management company, the pricing is a lot more appealing?
Well, I think it's probably the best fixed income market to be in if you're looking at the government bonds, because the fact that the economy should be slowing over the next year or two means you're not going to see any rate hikes out of China, and you might even see some rate cuts. Nothing that's going to occur in the next 1 quarter or 2 quarters, but just kind of a reminder that fiscal and monetary policy are working in a different direction in China versus other countries, and that means interest rates are probably going to be a lot more stable in China while they're moving up in the U.S. in terms of bond yields, and there's still some other EM central banks that are going to be hiking this year, mainly because of inflation problems. So if you had to own one bond market in the EM world right now, it would definitely be China, but this is the govie market, not the credit market.
The other thing that caught my attention is that Janet Yellen is looking to spare China from the currency manipulated tag. Are you surprised by that? And is that perhaps an early sign of a potential rapprochement on what has been a very tense start to the U.S.-China relationship under Joe Biden?
I'm not surprised at all. She's a real economist, and she knows what drives macro imbalances and external imbalances between countries, and she knows what qualifies as currency manipulation. And if you have a country that's not accumulating foreign exchange reserves, as China has not been accumulating foreign exchange reserves for years, it's kind of hard to call it a currency manipulator. So I think she's getting back to what's really the letter of that Treasury framework, which is to look at a number of indicators and not really give this subjective political overlay which the Trump administration gave to that currency manipulation report. And she's calling it for what it is. It's a largely market-determined exchange rate. There may be some massaging of the rate, which comes from state-owned banks, but the idea that the PBOC is manipulating it in a high-frequency way through reserve accumulation, it just doesn't hold.
John, we still have a lot more to cover. Hang on there to some of your ideas. John Normand of JP Morgan stays with us. We have some breaking news hitting the Bloomberg right this moment. In fact, Bitcoin has hit an all-time record high. It's kind of hovering very close to that level, but now we are at $62,000, surpassing that level. And that momentum has just been building bit by bit as more mainstream adoption has come into play. We will get more analysis later on in the program. But now, let's get you another preview of what else is right around the corner. After a rocky start, Europe's vaccination campaign is finally gathering pace. Up next, we'll discuss the impact on markets. This is Bloomberg.
countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Yusuf Gameneddin in Dubai. Bitcoin just hit an all-time high moments ago. $62,000 have been breached, and that comes ahead of a very important Coinbase public listing that is expected on the NASDAQ on April 14th. Let's head out to John Norman of JP Morgan, get immediate reaction. John, have you been increasing some of the recommendations around allocations to Bitcoin in portfolios?
What we've been telling clients is that it's a very unique asset if you're trying to hedge a simultaneous breakdown of a payment system and a debasement of the currency. But we've also been saying to clients that if you're looking for something that hedges inflation, this is a bit of a strange one to be hedging with. It is true that it's a scarce asset, or at least any individual cryptocurrency is scarce, but collectively the number of these that could be created is infinite. That's why it's a more unusual sort of inflation hedge than something else which could be in more fixed supply over the next couple of years, like particular commodities. So I understand kind of the uniqueness of them in a very, very extreme state of the world. But if really what you're trying to isolate is a modest move up in inflation, I think other hard assets are more sensible than crypto.
I mean, let's get to some of the conventional plays in Europe, because you've got, of course, a story of European stocks that are near record highs, and at the same time, this shift in terms of strategy. Do you stay long financials and consumer plays on the back of the sort of wider reopening?
I think you do stay long cyclicals regardless of what economy we're talking about, though I think Europe is particularly interesting going into Q2, because Europe could be the economy that gives you surprisingly strong growth even without tremendous fiscal stimulus. So everyone's kind of focused on the idea of U.S. economic exceptionalism because of all of the fiscal programs that have been approved over the past few months. But Europe is the place where you could see almost equivalent growth rates simply because of the reopening effect. So when you kind of put the overall amount of kind of aggregate economic momentum in play against the sectoral skew that European markets have, I think Q2 could be a quarter that gives you much better performance in European equities relative to the U.S., coming after Q1, where Europe pretty much held its own. And I think that was kind of a surprise to people to see European equities holding their own versus the U.S., when U.S. growth was so much stronger than Europe. Q2 could be, better growth in Europe than Q1, with the sectoral skew, which is just much more favorable given relative valuations right now.
John, but I look at how Europe's been handling the vaccination rollout, doesn't inspire confidence by any stretch of the imagination. Are they going to get their act together for this view to sustain then on the outperformance?
I think so. I think the most important policy item that the Europeans had to deliver on was stepping up vaccine supply, because what they had pre-ordered was woefully insufficient relative to the population, and it really trailed what the US and the UK had prearranged for their economies. So the big issue is supply going to step up? That was all prearranged by the end of Q1. You're already seeing the results of that in terms of week-on-week growth rates in terms of inoculations in big countries like France and Germany, and to a lesser extent Spain. So I think you're seeing a steepening of the sort of vaccination curve, and I think that's going to facilitate the reopening. It may not be 100% reopening in the way that people might like if they want to realize kind of extraordinary growth rates on the economy and everything that follows through that in terms of corporate profits, but you should see a pretty meaningful step up in terms of restrictions on mobility being lifted, and that following through to growth and activity and earnings.
John, it's been great catching up. Thank you for carving out some time in your schedule. That's John Norman. He's the JP Morgan head of cross-asset fundamental strategy. Well, still to come on the show, the showdown to succeed Angela Merkel continues. Her conservative bloc splits over the nominee for chancellor. We get the latest with the Berenberg chief economist Holger Schmiedling next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Stocks and futures pip higher in anticipation of today's U.S. inflation data. The St. Louis Fed President James Bullard, he tells Bloomberg that getting 3/4 of Americans vaccinated would allow for a taper debate. So there's seeds of doubt. Angela Merkel's succession plans are in disarray as the CDU-CSU bloc splits over their nominee for Germany's chancellorship. Plus, Biden backs chips. The U.S. president pledges $50 billion to help the industry amid a global shortage. And then you've got NVIDIA. Well, they've unveiled a new range of processors to chip away at Intel's most lucrative market. Good morning, I'm Yusuf Ghamedidine in Dubai, and welcome to Bloomberg Surveillance Early Edition on this Tuesday, 13th of April. Well, the SEC is cracking down on SPACs and their accounting rules. Regulators are changing the guidance for warrants, which basically are an option to buy shares at a specific price in the future. So far, so good. The move, though, threatens to disrupt new filings to a red-hot market. Joining us now to discuss this is Danny Berger. Danny, just give us a bit of color around the impact this is having.
Yeah, I know it does sound kind of wonky. I mean, we're talking about accounting changes after all, which can be part of a more or less a snooze, but warrants are a really important part of the fundraising process for SPACs because this idea gives new investors who get the warrant potential for more profits. So the changes here means that on the SPAC's balance sheet, it used to be classified as equity. Now a warrant is going to have to be classified as a liability on the company balance sheet. So that means that anytime there's a change of value of these warrants, they're going to have to account for that. And if the change is big enough, it means they're going to have to reinstate their financial statements. And you can imagine having to do this all the time if the values change is a really big headache and a big cost of money for accountants and lawyers as well. Bloomberg also saw a letter to clients from a big accounting firm saying that they believe the SEC is going to put current SPAC holdings on ice until they hammer out some of the details here. So it could also mean for the hundreds of SPACs that are in the pipeline at the moment, Yusuf, they're not going to go anywhere anytime soon.
Yeah, Mohamed Al-Arian was talking about how important it is that the Fed get to grips with maintaining and nurturing financial stability. So it's interesting to see this SEC move and how they're suddenly placing so much scrutiny on these SPACs.
It's definitely true, but to some degree, as Al-Arian was arguing, you kind of have to have this scrutiny considering how massive the market has gone. I mean, look at 2021 year to date. It dwarfs all the other full entire years we've had. 3/4 of the market right now in listings of the U.S. are SPACs. It's not IPOs. So the SEC, I think, has to come to grips with this behemoth that's entered the market. Last week, the SEC did say, or at least hint rather, that they're going to look at SPACs the same way they look at IPOs. They're not going to get any special regulatory treatment. So this might just be an accounting thing for now, but you have to wonder, Yusuf, is this just the first step of many that the SEC is going to take to more closely scrutinize SPACs?
I wonder about many things every day. Danny, thank you for the moment. Danny Berger there. Let's get to Germany now, where the showdown over Angela Merkel's successor continues. The parties in her conservative alliance, they're basically split on who should be the candidate for the top job. The various CSU has backed its chairman, that's Markus Söder. He's snubbing its larger sister party, the CDU, which is supporting its leader, Armin Laschet. At the same time, the country is grappling with the stubbornly high coronavirus infection rates. The cabinet has just moments ago passed a measure to tighten Germany's pandemic restrictions. Joining us now is Holger Schmieding. He's the Berenberg chief economist. Holger, I mean, run us through your analysis here. This is quite a bold move, isn't it?
Well, first of all, let's stick to the politics. This open conflict is, of course, bad for the chances of the Conservatives to win the election on the 26th of September. By and large, I would say that of the two contenders, Laschet, because he has the backing of the stronger part of the Conservative parties, is a bit more likely to prevail in this fight. But as he is also by far the less popular of the two candidates, that in itself will not improve the chances of the Conservatives to win. We have, in response to the current conflict, reduced our probability that the Conservatives, that is Angela Merkel's group, will lead the next German government after Merkel from 70% to 65%. They are still ahead, but less so. The chances of the Greens winning the election are still not that high, but they've moved up a little with the conflict. And unfortunately, all this is now happening at a time when we really have to grapple with the third wave of the pandemic.
Holger, let's go with a scenario where there is an open conflict between Laschet and Söder. To what extent would that tarnish the reputation of the CDU, CSU in a time where their political capital has already been running a little bit low?
Yes, they've fallen back in opinion polls quite significantly recently because, well, the vaccination campaign is not going well. That's bad for the government. And secondly, because there was a bit of a kickback scandal in the parliamentary faction of the Conservatives. This now adds to their woes. I think key is, first, it needs to be resolved fast. If this drags on well beyond this week, that could be really bad. And secondly is whoever wins will afterwards need the full public backing of the one who loses in this context test. This is difficult, but hopefully, you would say for that party, doable. We will probably know a lot more by next Monday, when also the Greens will present their candidate to be chancellor.
What are the likely policy implications then of some of your predictions? How meaningful a shift is it going to bring to the fiscal priorities of the land?
The potential impacts of German election outcomes on fiscal policy are often overstated because Germany has two chambers of parliament, and major things, be it on the European and the national level, typically need the approval of the second house of parliament, the sort of equivalent to a bit of the US Senate as well. Hence, if there is a change in the government in Berlin, that in itself has only a modest impact on fiscal policy on the German and European level. If it's a Green-led government, it would all be a bit looser, but not much so. The major impact could come if we had, as a tail risk, a government led by the Greens in a coalition with the Social Democrats and the hard left party. That is, if we have a government without any conservative or liberal inclusion, then we could see significantly more regulations. As in the US, regulations, labor market and the like housing market, is something where a lot of things could be done without the second house of parliament.
We had data out a few days ago around German production, basically casting a shadow on a lot of the initial enthusiasm that there would be a quick recovery. What is your current outlook for German GDP growth?
The German GDP could expand quite nicely this year. We have a fairly strong bounce this year. We expect 3.5% growth. It will, of course, only start sort of in May, if by then restrictions can be relaxed. These industrial output data have been affected by the shortage of semiconductors in the car industry. If we look at the PMI surveys for manufacturing, if we look at strong bounce in manufacturing orders, it's all there that is needed for manufacturing to go up strongly once the supply bottlenecks can be eased, and the service sector should rebound once restrictions can be eased from hopefully May onwards. So after a delay into, well, probably late April, early May, the recovery should get going, not quite as fiscally supercharged as in the US, but it should still be quite nice.
Bloomberg Economics talks about a forecast for 2021 of 3.3% and 3.5% for 2022. It's very close to what you were just talking about. Holger, I want to end this conversation sort of where we started around your impressions of this election process, you being on the ground over there. Just give us a bit of context around what the conversations and the debate have been like in the German public.
First, briefly, for next year, we have 4.6% growth for Germany, so we expect a strong rebound. Now, the conversations about this, there is a lot, you could say, of public dismay about what's currently happening in government and within the Conservatives, that the Conservatives have two contenders to be the successor to Angela Merkel has been known sort of for quite a while. Why on earth could they have not settled that behind closed doors peacefully, amicably? It has to be settled one way or the other. While at the same time, there is this discussion about how to fight the pandemic, a discussion between how much the federal level should impose on the states and how much leeway the states should have on their own. What is visible from all these discussions is that, say, the power of Chancellor Angela Merkel to really shape the debate, to get to conclusions, has waned a bit, and hence there is a bit of power vacuum is too much of a word, but there is a little hint of power vacuum in Germany while the pandemic is in its third wave, and that is, of course, not good for public confidence.
It's been great catching up, Holger. Thank you for your time. That's Holger Schmieding. He's the Bloomberg chief economist. Still to come on the program, eyes on supplies. President Biden pledges to address a worldwide semiconductor shortage in a White House meeting with CEOs. We have the details on that next. This is Bloomberg.
Wednesday on Bloomberg, David Rubenstein speaks to Federal Reserve Chair Jerome Powell in a virtual conversation hosted by the Economic Club of Washington, D.C., live at 12 p.m. Wall Street time on Bloomberg Television and Radio.
I've been saying for some time now, China and the rest of the world is not waiting, and there's no reason why Americans should wait. We're investing aggressively in areas like semiconductors and batteries. Chips like the one I have here, these chips, these wafers, are batteries, broadband, it's all infrastructure. This is infrastructure.
That was Joe Biden at the Chip Summit at the White House with several CEOs from the autos and semiconductor industry. Well, let's get out to Bloomberg's tech supply chain reporter, Debbie Wu, for more on this. Debbie, why did the White House hold this Chip Summit then, and did they make any meaningful progress?
Right. So we have seen American car makers forced to idle plants due to a lack of chips. That's mostly made by TSMC and other Asian chip makers. And other U.S. tech companies are also concerned about fighting with car makers and others for limited chip production capacity at these Asian chip-making facilities. So White House called the meeting to show that it is addressing such supply chain constraints, and U.S. officials are working to help bolster semiconductor manufacturing at home.
In terms of the deliberations that did take place, how do you benchmark any progress? What sort of targets have they come up with? What signals have emerged?
Right. So during the Chip Summit yesterday, U.S. President Joe Biden met a number of executives, including TSMC Chairman Mark Liu and then General Motors CEO and Ford Motors CEO. And they talked about the supply chain constraint, and most importantly, President Biden told these executives that he has bipartisan support for his $50 billion proposal to boost semiconductor research and manufacturing at home. Well, the president seems to have pledged a large amount of money, but how that money will be spent to help American companies with steady supply of chips, that remains to be seen as the Biden administration continues with its critical supply chain review to decide what the U.S. Would need in the future to help companies across a wide range of sectors to secure chips that's required to power a large number of devices.
Debbie, it's been fantastic talking to you. Thank you for that. That's Bloomberg's tech reporter, Debbie Wu. Well, let's get you the Bloomberg Business Flash again with Leanne Garrett. Leanne.
Hi, Youssef. Jack Ma's Ant Group plans to drastically revamp its business. The firm is bowing to demand from Chinese authorities that want to rein in the country's fast-growing internet giants, and will now be supervised more like a bank. That has far-reaching implications for its growth and its delayed IPO plans. Now, Veolia sees a lot of synergies in its deal to acquire rival waste and water management firm Suez, but the company's chief operating officer tells us there will not be job cuts. The firm is confident the deal can be completed by the autumn.
We don't expect any antitrust problem at all, although the process, as you can imagine, always takes a long time with all the antitrust authorities. But just to keep to give you one example, we've just obtained a few days ago the clearance from the US DOJ.
And two of the world's most powerful money managers are joining forces on climate change. BlackRock and Temasky are raising one of the largest venture capital funds dedicated to carbon-cutting technology. It will take stakes in startups with the potential to reduce the world's reliance on fossil fuels. They are committing $600 million to that very effort. And that's your Bloomberg Business Flash. Youssef.
Thank you very much for that. Well, Bitcoin has hit an all-time high of above $62,000. Let's circle back then to a cross-market check here. We're at $62,412. Basically, Coinbase is scheduled to go public on the NASDAQ on April 14th, and the token surpassing the previous high that was set in March this year. Some of your other moves here on the S&P 500 mini contract, we're just marginally up, and that shows you that there's a little bit of pause for reflection. In the bond market, it's going to be a busy few hours in terms of issuances. And that is going to be coming through from the Treasury over the coming hours. We had already, of course, those numbers coming through, and the expectation is that you're going to get a $24 billion worth of a 30-year reopening, and that's going to be reflected. We're at 168.72, and then WTI just moving up a little bit here, about 1/5%. Well, coming up, Huarong's bonds in China, they blow up basically as traders circulate rumors that China's biggest bad debt manager discussed bankruptcy. The shockwaves are rippling through some of the other asset classes. We're going to discuss that story next with Bloomberg's Opinions Anjanji Trivedi. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Yusuf Gameneddin in Dubai. Let's take a look at what's coming up today. First up, OPEC releases its monthly oil report this afternoon. That includes demand forecast and production estimates. And then the much anticipated U.S. March CPI data is going to be published at 1:30 p.m. UK time. It's expected to show a heady acceleration from last year's pandemic conditions. And then you've got the luxury goods giant LVMH. They're going to be reporting first quarter sales later in the day, with estimates suggesting that it's the fastest rise that they've had in sales in about 6 years, driven by demand in the U.S. and in China. And to wrap it all up, you've got the U.S. Energy Secretary Jennifer Granholm and the White House National Climate Advisor Gina McCarthy. They're going to be speaking at tonight's Bloomberg New Energy Forum Summit. The Bloomberg event brings together leading voices in the energy industry, transport, technology, finance, and government. Jam-packed. I want to get to the panic that is growing in China's debt markets. And there are worries that it could cause a wider contagion. Bonds linked to the country's largest bad debt manager, Huarong, have slumped this morning after traders circulated a Caixin report that discussed the possibility of bankruptcy. It has now been put on review for a downgrade in the last few hours, first by Moody's and then a few moments ago also by Fitch on a rating watch negative. But how did the asset manager that's been created, basically, they've been intended to clean up Beijing's toxic debt. How did that become part of the problem? Let's figure that out and try to figure that out with Bloomberg opinion columnist Anjani Trivedi, who has been covering this story today. Anjani, most people would have never heard of this particular asset management company, but it is massive in size and very closely linked to sort of the plumbing of the Chinese economy, isn't it?
Yep. You know, this BAB, it's the nation's largest distressed asset manager, and it runs, you know, it's sitting on $263 billion of assets. Now, these institutions, there's four of them that were basically set up in the 90s to clean up to help clean up the bank's balance sheets as reform was happening and so on. Now, no one's really heard of this, but there's a ton of U.S. dollar denominated debt that's outstanding, and it's starting to worry foreign investors and creditors sitting in Hong Kong and outside looking at this debt. These were supposed to be, they've often taken comfort in the fact that these are very closely linked to the state. The finance ministry has a large, ownership in it. I think the issue, though, now is becoming that people are beginning to realize that these kind of asset managers have been under scrutiny for the last couple of years. And I think, regulators have given them more in terms of, cleaning up the financial system, which has come under a lot of stress over the last year or so, last couple of years, in fact. But yet at the same time, they're trying to rein them in because they have become deeply and directly intertwined with the capital markets and with the money market.
I mean, just moments ago, the lines crossing the Bloomberg as well, that China is set to be mulling shifting the Hurong stake to central Huijin. What's the domestic conversation going to be like among policymakers around this issue?
Well, since the chairman of Hurong was taken in 2018, and then he was executed earlier this year, these asset managers were under the magnifying glass. Last year, regulators were already discussing if there was a way to ring fence their own risk, the Ministry of Finance's risk, away from these institutions. In fact, they created a new national asset manager last year. You could speculate that was going to, they knew that Hurong wasn't going in the right direction. The other asset managers have cleaned themselves up. So I think it's going to be, there's going to be conversations around how do we manage these assets, which a lot of them are illiquid. A lot of them they've been taking impairments on these, not just Hurong, but all of the asset managers. So it's going to be a lot of, what do you do with these bad debt assets, which have a lower and lower recovery value? So if there's a price to be put on them, that's fine. But the problem is a lot of these assets, the value has been waning for the last year or so. So that's going to be a conversation. When where are the contingent liabilities sitting? Who is going to be, who do they care about in their pecking order?
Sure.
Does the Ministry of Finance, the state holds the equity too, right? So, and who's left holding the bag at the end of the day?
Of course, a lot of questions still outstanding, and as we see some of these other Chinese dollar bonds beginning to slump and sort of Asia credit risk come under fire as well, a lot for investors to digest in the coming hours. Thank you very much, Bloomberg opinion columnist Anjani Trivedi in Hong Kong. Well, we are looking at markets that just reflecting a bit of caution then as we wait for the critical U.S. CPI numbers coming out later on in the day. Plenty more ahead. This is Bloomberg.
that Norway sells way more electric cars per capita than the U.S.? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric. Last year, Norway became the first country in the world to sell more electric cars than any other. In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We want to recenter inflation expectations at 2%. This is an ideal time to do that.
The change in policy is well motivated. The risk is that the Fed will be late.
We have record amount of monetary policy, record amount of fiscal stimulus. I've never seen more cash on the sidelines.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Good morning from New York and Berlin on this Tuesday, April 13th. Our top stories today. Countdown to CPI. Traders are awaiting today's U.S. Consumer Price Index report. Faster inflation could hurt bonds and stocks with long-term horizons. Trade is on track. Chinese exports and imports surge in March. It's a sign the global recovery is well underway. And money managers go green. BlackRock and Temasek team up to create one of the largest funds dedicated to carbon-cutting technologies. I'm Kaylee Lines in New York, Matt Miller in Berlin. Francine Lacqua is off today, so it's just you and me once again, Matt. And really, it's all about inflation and that CPI print coming up at 8:30 a.m. Eastern.
Yeah, absolutely. For markets, that is going to be the key indicator. We're looking for 2.5% in terms of the headline number. The core number at 1.5%. These are year-over-year figures, of course. But it'll be interesting to see if we blow out in food and gasoline, because these are real problem areas we've been discussing. You know, the people who were hurt the hardest by the pandemic, those two items make up a huge portion of their monthly income. So if you can't keep that under check, it's going to be a problem for Jerome Powell.
Yeah, those pricing pressures definitely will be felt by certain areas of the U.S. economy, Matt, but we have to keep in mind base effects, base effects, base effects. I've seen the word base effect more times in the past, like 24 hours, than I think I had seen in my entire life up to this point. I do want to get a check on what markets are doing ahead of that CPI print. In Asia, it was a bit of a mixed session. You did have both Hong Kong and Japanese equities closing in the green. The Nikkei, actually the outperformer, up about 0.75%. A little bit of underperformance, though, coming from China. The CSI 300 down by about 2/10. On the one hand, you did have that positive trade data. It is on track when it comes to the recovery. But then you also have rising concerns about the health of Huarong Asset Management, one of the biggest bad loan managers in China. Its bonds under continued pressure, and that route is starting to bleed into sentiment more broadly. I also wanted to point out the yuan. It is slightly weaker against the dollar, but only by about 1/10 of 1%. Janet Yellen, the Treasury Secretary, Bloomberg is reporting, will not label China as an FX manipulator in her first semi-annual foreign exchange report. I want to flip up the board and talk about Europe as well, because again, it was a mixed picture to start. Not huge movement anywhere on the continent right now. We're up about 0.25% on the stock 600. The FTSE 100 in the UK is just slightly down. Marginal move only by about 0.1% is the FTSE lower, but again, something to keep an eye on. I also wanted to note in foreign exchange, the British pound is one of the outperformers in the G10 space. It's up against the dollar by about 0.1% right now. The cable rate sitting at 137.51. And in the bond market, we are seeing yields creeping higher. We're up a basis point on the 10-year German bond yield right now, sitting at negative 28 basis points. As for what the picture looks like here in the U.S., we did close just off record highs on the S&P 500 yesterday. Today, futures are up, but really just fractional, 0.5 point on E-minis. Really, the action's going to be in the bond market ahead of that CPI print, what the reaction in treasuries will be to that inflation data. Ahead of that, yields moving up by 2 basis points. We're nearing 1.7% on the 10-year once again. That is aiding the dollar, and we have to keep an eye on Bitcoin as well. It is at a new all-time high above $62,000 for one crypto coin, Matt.
Wow, absolutely amazing there with Bitcoin. And of course, the Coinbase IPO is going to be a key in that. One question that I was talking yesterday with Joe Weisenthal about is, does this Coinbase IPO with a $100 billion valuation take flows away from Bitcoin, or does it get more people into the alternative asset? Looks like the latter is the case, at least today. Kaylee, I want to bring you one headline that we're seeing cross the ticker here in Germany. The ZEW April investor expectations gauge fell to a 70.7. We were looking for a gain to more than 79. Of course, as you know, it's been rough sailing here in terms of the coronavirus. Infection rates continue to spike, can't be held under control. Angela Merkel, the chancellor, is looking at changing the law to get more federal power over what the states do, and she's going to speak in just about an hour and a half in Berlin. So we'll definitely keep an eye on that. What else should you be watching today? Let's tell you here in a quick roundup. Bloomberg brings together leading voices in energy, transport, technology, finance, and government at today's BNEF Summit. The U.S. Energy Secretary Jennifer Granholm and White House National Climate Advisor Gina McCarthy will speak there. OPEC also releasing its monthly oil report this morning, and the much-anticipated U.S. March CPI data will be published at 8:30 a.m. We've been talking about that. We'll continue to cover that throughout. But, Kaylee, there's so much more going on here in Europe. You've got defense ministers meeting in Brussels as geopolitical hotspots flare up on the eastern Ukrainian border, as well as between China and Taiwan. So we'll likely see statements out of Antony Blinken all day long. And we've got, as I said, this possible new federal law in Germany to try and clamp down even harder on an economy that's been hit so hard. One of the reasons the ZEW survey missed by so much.
Yeah, lockdown's obviously a continuing problem in Europe, Matt, but you do, it seems, have a little bit of reason for optimism on a speeding up vaccine rollout. Again, you have a long way to go over in Germany or really anywhere in the European Union to catch up to what we're getting here in the U.S. or the UK, but there may be some reason for hope. Maybe someday soon, you too could get a jab in your arm, Matt.
Yeah, I'm hoping to fly home to New York and get one someday very soon. Key trade data from China as well this morning. Imports hit a record in March and exports climbed too, though less than expected. The continued momentum after record export gains in February is being seen as a positive sign for global demand recovery. And here to talk to us a little bit about that is Bloomberg's chief Asia economics correspondent, Enda Curran, out of Hong Kong. So, Enda, what are the key takeaways from the trade data?
Well, on the export side, Matt, like you mentioned, we had something of a miss on the economist forecasts and a slowdown in volumes compared to the months before, but we still had 30% growth plus in dollar terms, so it still points to pretty robust demand and growth in China's merchandise goods sector as it ships the kind of products to the rest of the world that we've all been using through the pandemic, the work from home kit and healthcare kit and so on. However, underneath the hood of the data, there is some suggestions that perhaps demand for that kit is actually starting to wane a little bit now. So economists are saying that perhaps we'll see a plateauing, if not a cooling, in fact, in China's export story over the coming months. It's still a pretty strong number. I think any other economy would like to have exports of over 30% growth on month, but economists say now some signs of a cooling, which could be something to keep an eye on over the months ahead.
And another thing we're keeping an eye on in China, Edna, is Matt's daughter is named Edna. I've been confusing the two all morning. But Huarong Asset Management, what is going on there and how much could this bleed into other assets in China?
Yep, well, look, Huarong is one of the big bad banks in China, one of the 4 big asset managers. It's at the center of the financial system, listed here in Hong Kong in 2015. Its biggest shareholder is the finance ministry. The reason people are pretty unsettled and nervous is because they don't have much transparency to what's going on. Is there going to be a restructuring here? Is there going to be a transfer of ownership? Or our colleagues in Beijing have just reported that perhaps the finance ministry might transfer some of its stake to one of China's other sovereign wealth funds. So there's lots of question marks over what will be the fate of Huarong. And that's why we're seeing this nervousness spill over into the broader market in terms of China's stock markets and bond markets. We're seeing a sell-off there. So it's certainly a rattling of sentiment. One economist described it as a $25 billion curve. So it's something of a big whale when it comes to credit markets in Asia.
And Curran, I do have to say there is a striking likeness, and my daughter Edna Sprague Tully is also very Irish, so maybe that's one of the reasons. Our chief Asia economics correspondent there out of Hong Kong, thanks very much. China's an issue we'll continue to cover, but also bank bonuses is a big issue today. Credit Suisse has slashed the amount of money set aside for bonuses by hundreds of millions of dollars, and they're using the savings to limit the financial hit from the implosion of Archegos Capital Management. That's according to the Financial Times. Let's bring in Danny Berger to see what she's been digging up out of the London office. Danny?
Matt, we do continue to really get this drip feed of what Credit Suisse is doing to try to mitigate some of the big losses it saw from Archegos. So this report from the Financial Times, citing sources, talked about the bonus pool set aside. Now, if you take away the cuts from that and some one-offs, it means that Credit Suisse for the first quarter is going to add back about $600 million rather worth of earnings before taxes. So that profit's going to come back. Now, it is possible, considering, this is an accrual pool of bonuses, they could add that back later in the year. So it's not game over for those at Credit Suisse hoping for a chunky bonus. Though Credit Suisse, I just wanted to flag, also moments ago released an update on Greensill, saying it's paying investors back another $1.7 billion. The second time it's made repayments. That means taken all together, they've now given investors back about half of the AUM of Greensill and the other supply chain linked funds when they were initially frozen, saying they'll give more updates in April. So if you want more Credit Suisse news, if you don't want it to end, we at least have a few more weeks of it to come, Kaylee.
Yeah, will it ever end? 2 crises going on at the same time that are still ever evolving. Bloomberg's Danny Berger, thank you so much. I also want to take a look at some stocks moving in pre-market trading here in the U.S. One of the big outperformers is actually Azek Companies, excuse me. It is a outdoor furniture maker, outdoor living products. It's up about 3.8% before the bell. It was raised to a new outperform at Wedbush. $52 price target. It's trading just below $49 this morning. We're also seeing some gains for some of the cruise stocks, Carnival and Norwegian, each higher by around 1%, over 0.7% for Norwegian. Some reopening optimism there. And I wanted to point out GameStop could open lower for a 7th day in a row, extending its longest losing streak in a year. Of course, it was downgraded yesterday by Ascendiant Capital Markets analyst Edward Wu. He cut his price target to $10 this morning in pre-market trading, down 1.3%. It is trading at $139 at the moment, Matt.
All right, very interesting look at some of those morning movers, especially ahead of the Coinbase IPO. I feel like we could even get not only more crypto involvement, Kaylee, but more retail involvement in this market. So it's interesting to see GameStop down in the pre-market. Coming up next, Christian Nolting, Deutsche Bank International Private CIO, joins us to talk about what to expect in terms of inflation and how to deal with these hotspots that we're seeing geopolitically around the world. Could they simmer to a boil? Later on today, Jared Bernstein, White House Council of Economic Advisors, joins us. That's at 7:30 a.m. New York time, 12:30 p.m. London time. This is Bloomberg.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller here in Berlin with Kaylee Lines in New York. Francine Lacqua is off today. Let's take a quick look, Kaylee, at something you mentioned in the last block, and that's base effects. I've got a great chart here that our own Dan Curtis put together in the New York newsroom. On the top, you can see the year-over-year CPI, and it's the core number, okay? This is important because the Fed pays attention to the core number. I'm sure they see all the data, but really core PCE is their main focus. On the bottom of this chart, for those of you who are listening on radio, what we see is the base effects. That is the headline number the core number of last year, and there's a dip at the end of the chart because, of course, the lockdown hit us all so hard. There was a drop in prices, and the base effects, Kaylee, that we hear everyone talk about are that drop amplifying the jump that we're going to see likely in today's number. Joining us to talk more about this is Christian Nolting, the CIO and Head of Investment Solutions at Deutsche Bank International Private Bank. Christian, how important are these base effects, and what kind of jump do you think we're going to see in CPI today?
Well, I think these base effects, they have been talked a lot about, but I think they are very, very important because I think if numbers go higher, which I would expect for today, so because of that base effect, but also of some developments we've been seeing, markets would get nervous because all the discussion will be on when is the Fed ready to start discussing tapering. Could that be as early as this year, which I probably would agree with. And from that perspective, it would have an impact on yields. And then you see the impact from yields into the equity market. So all asset classes literally would be impacted. And that's because of the base effect. But I think just to say it's a base effect, the market doesn't care because everyone knows, I think that would be wrong. We have seen that this is not the case.
So in terms of today's number, we're looking for a headline figure at 2.5% because the transitory goods like food and gas have seen stronger price increases, but we're looking for a core number of 1.5%. What are you looking for, and how will the markets react?
Well, I think if we see really an overshooting also on the core number, I think that the market could react with higher yields, and maybe that's not only the case in the US, but also in Europe. Because think a little bit of it, I think we've seen yields rising everywhere, but especially in the US. Now in the second quarter, and that's why this inflation number could also spill over to Europe, in the second quarter, we will probably see more optimism in Europe, hopefully. It doesn't look like now, but if vaccinations are now getting faster, then of course there could be some similar development. That's why I think there will be a very close eye on what we see. And let's not forget energy prices, right? If you look at the difference of the two. Last year in April, we have seen negative oil prices, and that's no longer the case. You see that massive base impact, which really is coming in, especially now.
So, Christian, does the calm we've seen in the bond market and the treasury market specifically in recent weeks potentially end today? Because we have seen not a huge reaction on an upside surprise for non-farm payrolls, for ISM data, for PPI. I mean, is this data going to be different?
Well, I think if we really see uptick as per the forecast in the market and the expectation, I think then there will be more volatility in the bond market. If not, then probably it remains calm, because I think there are two sides of the medal, right? So if yields are rising further, there's also more demand coming in for US treasuries, for sure. But I think if numbers are expected, let's say, are delivered to the upside, then there is more volatility from my point of view, because people say, well, that's really going faster. Central banks are saying, yeah, that's a transition, which I agree with, but still, if you see high numbers, markets would react to that. I wouldn't be surprised, really.
I want to shift focus to the equity market as well, because in addition to CPI, we also have earnings beginning to roll out this week, starting with the big banks tomorrow. Is the bar too high? What happens if we fail to meet it, given how much has been priced into the equity market already?
Yeah, I think, look, earnings are expected to, let's say, be up 23%. So that's a massive number, of course. But I think what's important is, as companies, they need to deliver on this. And if they over-deliver, fine, the bar is quite high, I have to admit. If they under-deliver, they will be, I think, punished quite substantially, and that could bring volatility up. Look at the VIX in the US, we are trading below 17 now, which I think is very, very low. It's the lowest level since before the crisis started last year, actually. And so any disappointment in now the upcoming earnings season because of high expectations would be leading to higher volatility on a single security name, but also on the index level, I think in general, how the earnings season is now developing.
Absolutely. VIX at a 17 handle, as I've said before, something I did not know if I would ever see again. Thank you so much for your time today, Christian Nolting, CIO and Head of Investment Solutions at Deutsche Bank International Private Bank. And coming up tomorrow, Fed Chair Jerome Powell will be speaking at the Economic Club of Washington with David Rubenstein. Stay with Bloomberg for our coverage starting at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day. This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Matt Miller in Berlin. Francine Lacqua is off today. Now let's get the first word news. And President Biden says he has congressional support for government funding to address the semiconductor shortage. That shortage has forced automakers around the world to shut down production lines. The president spoke at a White House meeting with more than a dozen CEOs. He says there is bipartisan support for his $50 billion proposal for chip manufacturing and research. Bloomberg's learned that U.S. Treasury Secretary Janet Yellen will not name China a currency manipulator in her report due this week. That allows the U.S. to sidestep a new battle with Beijing. During the Trump era, the administration was accused of politicizing the report by abruptly naming China a manipulator outside its normal schedule. Oil output levels in the U.S. are nearing levels not seen since the start of the pandemic. Production in the Permian Basin, the U.S.'s most prolific shale patch, is set to reach a one-year high next month. Higher prices are making drillers more confident. Benchmark NYMEX oil gained almost 35% in the last 4 months. And the Securities and Exchange Commission is cracking down on a key element of blank check companies. The agency is issuing new guidance on warrants, which are issued to early investors in the deals. They may no longer be considered equity instruments and may instead be liabilities for accounting purposes. That could disrupt filings for new SPACs. And that maybe it's just because I know bank earnings are coming up tomorrow, but I've been thinking about what this means for deal making and fees for some of these major investment banks who have benefited in a huge way from the SPAC boom we've seen over the last year.
Yeah, actually, Bloomberg reporter Jenny Serrain had a great piece yesterday on the fact that this may be the quarter for deal makers rather than trading units boosting revenue. SPACs have, of course, been a massive piece of deal makers' revenue in the last quarter, and there are hundreds more in the pipeline, Kaylee. So if this doesn't get dealt with quickly, it could really put the brakes on Wall Street earnings. It's a very good point.
Yeah, 550 SPACs have already filed to go public in the U.S. this year. It's already April 13th. It is truly remarkable. All right, coming up next, James Pomeroy, HSBC global economist, will be joining us. This is Bloomberg.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
Neom will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain Neom on the back of a set of PowerPoints and a video clip. You just need to be here. You need to, breathe it. And specifically the startup mode and, things happening. Buses all around you here.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Matt Miller in Berlin. Francine Lacqua is off today. And Matt, I'll say it once again, it's CPI day, and I'm not even sure that anything between now and 8:30 a.m. Eastern time really will matter. Market's really just in a holding pattern until we get that data.
To you, right? Because I'm watching, in 1 hour, Angela Merkel is going to come out and talk about a new lockdown law. And of course, we're all feeling the fatigue here, but we have been able to go to the hairdresser, not me, obviously, but kids have been going to school, etc. All of that could end with this new law. So as Francine is probably enjoying a nice brunch in the pub this morning, we could be subject to curfews here in Germany. Not that I ever stay out that late, but
No.
it's difficult to deal. Thank you for your concern.
Well, I am very sorry for you, Matt. I will continue to be enjoying my not really lockdown life here in New York, and you can live vicariously through me. So maybe we can make that deal. I'm not sure that helps, though. But I do feel for you. All right, let's get a quick check on the markets. As I said, not a whole lot of action ahead of that CPI data, at least in the equity market. We are up about 0.25% on the stock 600 in Europe. Here in the U.S., though, futures essentially flat. We're up less than a point on S&P E-minis. You are getting some action in the bond market ahead of that print at 8:30 a.m. Eastern time. We're up about 2 basis points on the 30-year yield and sitting at 2.35%. Of course, for the Treasury market, it isn't just about the CPI data, but also Treasury auctions. Pretty good takedown for the 3- and 10-year auctions yesterday. We get another $24 billion in 30-year supply coming online at 1 p.m. Eastern. So that is why I'm watching the 30-year yield in particular. I'm also watching Bitcoin, 62,500 almost, a new all-time high. The Coinbase IPO, obviously, a lot of anticipation for that, and that is aiding the cryptocurrency. That is also aiding a number of stocks tied to crypto in pre-market trading. You have both Riot Blockchain and Marathon Digital Holdings up around 7% in the pre-market. Also, still some strength for some of those EV companies. Quantum Space up about 1.5%. Tesla is higher as well, and of course, for Tesla, that isn't just an EV story. That is also a Bitcoin story after the company made the investment in Bitcoin earlier this year, and we know Elon Musk counts himself among the crypto faithful, Matt.
Yeah, absolutely. Interesting to watch all this interest come back in to the market ahead of the Coinbase IPO. Kaylee, I'll be paying very close attention to that. While we were talking about tighter German lockdowns, the brilliant and bearded Daniel B. Curtis in New York put together this chart for us, which is pretty great. It shows, well, it's bad, actually. It's a bad bad news chart, but it was good that he was able to do it so quickly. It shows Germany's coronavirus contagion rate climbing at the beginning of 2020, and then it came down substantially at the beginning of 2021. Everyone thought we were cool in February and that we'd be getting our Wiener Schnitzel and Hefeweizen at the beer garden, but now we've seen another climb, and this is really problematic. Kaylee, we saw the ZEW investor confidence numbers coming out today. We thought we were going to see a climb to 79, and the gauge actually dropped instead to just above 70. So it's something that's on the market's minds for sure. James Pomeroy joins us, global economist at HSBC. And James, of course, we're going to focus in on U.S. CPI. But first, I want to ask your thoughts on what's going on here in the heart of Europe, the economic engine of the EU. Germany is having real problems, and Angela Merkel is looking to change laws to deal with them. How much of a concern is it?
What's really interesting is how across the world you've got this really divergent story in terms of both the COVID outbreaks and in terms of vaccine rollouts. And most of the Eurozone is unfortunately at the wrong end of that spectrum, where case numbers, as you say, are picking up. Vaccine rollouts have been relatively slow. And all of that together, I think, is clearly a concern for economic activity. If you start to see more restrictions come into place, clearly that's going to weigh on the recovery for the time being. But the slightly more optimistic side of that would be if we look across those economies so far in 2021, where we've had restrictions in place and we've had some of the monthly GDP data, such as the UK this morning, those numbers are better than we may have expected. So there is some, from an economics perspective at least, some positivity you could take that maybe we're getting slightly better at dealing with these restrictions, but that probably doesn't help you sat in Berlin and wanting to get back out and do things much more quickly. So clearly this is going to weigh on the European recovery.
Well, and I don't even care so much about me. It's the small businesses all around me that I see shuttered and needing some kind of liquidity. Fortunately, Germany has been fairly good about giving out financial support. But we talked to Klaus Regling yesterday, the managing director of the European Stability Mechanism, and he gave us a very hard no on the possibility of any more fiscal stimulus coming out of the EU. Do they need it? His answer was, this isn't the United States of Europe. And of course, rich countries like Germany have been able to do what they can, but on the periphery, they're still in real trouble.
Yeah, most definitely. And we're going to have to see more stimulus in one way or another just to support businesses. Now, some of that will come through some of the systems that are already in place to support businesses and to support jobs. And some of those may need to be extended, depending on how long this pickup in cases hang around for and how quickly the vaccine rollout can happen. But it is one of the big risks, not just in Europe, but across the world in the course of 2021, that these small businesses that have been so beaten up during the course of the last 12 months, they really struggle, even as we come out of these restrictions, because their cash flows are down, their profits are down substantially, their costs haven't necessarily dropped, and whether those businesses can survive is going to be a really, really important part of the recovery. And that's why we're seeing more and more stimulus across the world come into those businesses, and why it would make sense, at least, for that stimulus to be extended, because these businesses employ a lot of people as well. It's not just about the small business owners, they also create a lot of jobs. And if we were to see bankruptcies pick up in these smaller businesses, then that's going to be a real challenge for the recovery, and we could see this weak economic story played further and further through 2021. And it's one of the big downside risks, I think, for the global recovery this year.
Well, of course, James, we've had much more robust stimulus here in the U.S., where I speak to you from, and that raises the inflation question. I know the CPI print coming up later this morning, yes, the base effects will be a factor, no doubt about it, but to what extent do you think inflation risk is actually skewed to the upside?
It's a really interesting question, and quite clearly over the next couple of months, we're going to see those inflation numbers go higher, starting today and then over the course of the next 2 or 3 months. But then we think we're going to see inflation come down in the second half of the year, and that's for two reasons. One is this rotation out of goods into services. So some of that goods price inflation should dissipate. Some of these backlogs, some of these pricing pressures should start to dissipate in the second half of the year on the goods side of things. And while it's quite obvious we're going to see a lot more demand for the likes of hotels and flights and restaurants where prices could go up a little bit, the one thing we've been flagging is rental inflation. And what I think is a really important part of this story, particularly in the US, is we're seeing rents in big cities down about 10% from where they were pre-pandemic. And more people are now taking out rental contracts at these lower costs. And that slowly is going to feed into that CPI rents number. And actually, over the course of the next 18 months, it's going to be very, very hard for CPI rents to get back to where it was pre-pandemic. And if you do the sort of maths of that, the other components really have to do a lot of work. So we could see inflation move much higher in the next couple of months, but we think over the course of the next 18 months, it will then drop off a little bit. And that's why we think the Fed stays on hold.
Well, I'm glad you brought up the Fed, James, because we had St. Louis Fed President James Bullard speaking on Bloomberg Television yesterday, and he said the time to talk about tapering will come when we've had about 75% of Americans vaccinated. Based off of Bloomberg's data, that's in 3 months from now at our current pace of vaccinations. Do you think that there is a risk that tapering, or at least taper talk, is going to come way sooner than the Fed has suggested it will and that the market anticipates?
So this talk's clearly going to ramp up throughout the year, and I think it's going to be hard to get away from that discussion, particularly within markets, as you start to see some of the better data. We've seen a lot of the numbers in the last month in the US look particularly strong, and the chances are those numbers are going to stay pretty robust over the next few months. And if anything, you're going to see an acceleration as the economy reopens. And I think there's two parts to this. One is how quickly can you vaccinate everyone, but also how quickly does economic activity rebound to sort of pre-pandemic levels. And on our forecast, at least, we're going to get to those pre-pandemic levels of activity by the middle of the year. And so suddenly you're going to start to see this sort of discussion change a little bit, where you're back at pre-pandemic levels. How do things change? And we think those tapering discussions do sort of kick in the second half of the year, and we see some tapering over 2022. But really the big thing that matters is the rate rise, and we don't see that happening anytime soon. So there's going to be a lot of discussion about how necessary is it for central banks, not just the Fed, but across the world, to keep monetary policy so loose in an environment where activity is back at pre-pandemic levels. But because of this high level of debt that's been accumulated, we think monetary policy does stay loose at least until the end of 2022.
Yeah, they're not going to say that they're helping to monetize the debt. Certainly, we've heard some pushback against that, but it does help in the end, I guess, depending on what side of the trade you're on. James, thanks so much for joining us. James Pomeroy is a global economist at HSBC. Coming up, China is ramping up military pressure in Taiwan. What it means for U.S.-China relations next, as Antony Blinken meets with defense leaders in Brussels. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kaylee Lyons in New York. Francine Lacroix is off today. But let's get to the big geopolitical tensions that we're seeing around the world. China's Air Force has now sent 25 fighters and bombers over the Taiwan Strait, escalating military pressure on the government in Taipei, which has been boosting ties with the United States. Here with us to talk about this and more is Bloomberg's executive editor for international government, Rosalind Matheson. So, Roz, what's the issue? You know, the Chinese started as soon as Biden came into office. I think I saw in a Bloomberg copy yesterday, 3 days later, they were sending fighter jets and bombers over Taiwan.
Well, that's right. And this is something that has been actually going on for years. They have these air defense identification zones and they frequently fly in there. But certainly it's picked up since the start of the year, since Joe Biden was inaugurated, and very much Beijing sending a message to the US through Taiwan, which is don't mess with us and don't support Taiwan too much against us. And you can see that it's really accelerated just in the last few days with the largest group of planes going through so far yesterday. And China warning again, like, we're going to send patrol ships, we're going to send everything into that repeatedly. The risk, of course, is that Taiwan at some point moves against one of these planes coming in or one of these ships, and what would probably begin as a skirmish could quite quickly escalate into something far more serious.
Yeah, absolutely. And Rosalind, there's a great Bloomberg opinion column out today from James Stavridis, who is a former Supreme Allied Commander of NATO. He's actually was talking about the Ukraine and Russia issue and the escalations at their border, but saying China's paying attention. They're watching how the West reacts to that Russian aggression. How do these two issues tie together? What kind of cues could China be taking from the way the U.S. interacts with Russia?
Well, certainly China and Russia have sort of one thing in common, which is tensions with the US under previous administrations, and certainly very much under the Biden administration. His presidency has made clear that Russia will get much less of a pass, if you will, than they did under Donald Trump. And also, how do they deal with China as really the world's second biggest economy at this point in time, and saying we're going to come at both of you over things including human rights violations, including your actions on your borders, say Hong Kong and Taiwan for China, and obviously the area to Russia's periphery, including Ukraine and those breakaway areas, and saying in both places we're on watch with you. In fact, they've sent a ship to the Black Sea to sort of sit there and look very big and imposing. So what we're seeing is a sort of common set of problems in a way, and China and Russia have been indicating, in fact, they're working more closely together, not just economically, but saying strategically we need to band together somehow to act against the US. So you could see that increasing just in the coming months.
Are we going to see, speaking of banding together, much closer cooperation now between the U.S. military and its NATO allies? I'm just noticing headlines that, you know, while previously President Trump wanted to pull troops out of Germany, it looks like now 500 additional troops are going to be stationed in Germany. Not a huge number, obviously, Roz, but are we going to start seeing a lot more closer cooperation between the U.S. and allies that maybe felt left adrift during the last 4 years?
You'll probably see certainly more cooperation and collaboration, so more joint drills, for example, more working together on common issues. What you probably won't see, though, significant build-up of US assets inside places like Europe and so on, because even for Joe Biden, like predecessors, there's pressure at home not to be spending too much on defence overseas when you've got so many issues at home that require attention and money. And other predecessors to Joe Biden have had that pressure of saying you can't be sending hundreds of troops overseas to fight wars that are thousands of miles away that we no longer have a great vested interest in. So at home also it's politically quite difficult for Joe Biden to be ramping up the number of boots on the ground the US has overseas, but certainly joint drills and so on, we can probably see that increasing.
All right, thank you so much, Bloomberg's Rosalind Matheson. Great insight. We appreciate your time. And coming up, two of the most powerful money managers are joining forces with a goal to reduce the world's reliance on fossil fuels. We'll hear from BlackRock CEO Larry Fink and Temasek International CEO Dilhan Pillay next. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It took solar and wind 30 years to come to where it is today, but in the last 10 years, the way in which the cost curve has come down incredibly was something that many didn't foresee 10, 12 years ago, and yet it's happened. There's every reason to believe that if the right amount of capital, the right level of incentives and disincentives are put in place to encourage a transition to greener options, that we will see the cost curves come down to a level where it's commercializable and there is an ability to have it implemented in sectors where it would otherwise have been difficult to bring those solutions to bear. And I think that's something we should be striving for. And this venture is playing its part to do that.
Dilhan, what you just described may take years. Scaling these technologies and the companies behind them is a years-long process. How long will your investors have to lock up their capital?
Well, it's an early stage fund. So as an early stage fund, typically you have a time frame of 10 years plus one. And we haven't decided what the terms are fully, but we expect the fund to have the life of a normal early stage fund. And, it is a question of putting money to work at different stages. There'll be early stage, there'll be growth stages. Some of the companies may well accelerate faster than the others. The most important thing is to figure out which are the ones which are likely to make an impact in the sectors which need these solutions to be present. And to focus on these companies and to make sure that we back the right management teams, back the right sponsors, join with other investors, and bring in more capital, through our networks to these companies which are promising. And then hopefully seeing those solutions make their way into the marketplace and be part of a normalized business model.
If we had green hydrogen today, if we had biofuels closely approximating regular distillates and regular fuels that are hydrocarbon-based, the demand's there. And so now it's just the technology, some innovation to get it done. But I don't think in some of these areas that we're talking about are 10-year horizons at all. They're probably closer to 5, but there could be some technologies that we haven't even thought about yet that are going to be shorter. We will accomplish many of these much more rapidly if the world says this is a societal issue that we have to do it all together. If governments and policymakers just only ask public companies to move forward, we're not going to move as fast as society. But if government worldwide, especially in the upcoming COP26, if governments say this is a societal risk and every form of business operations needs to participate and move forward, then I believe we are going to see an acceleration in technologies, an acceleration in innovation. And so I'm actually very excited from what I'm hearing from regulators and their desire to move forward.
That was Temasek International's Dilhan Pillay and BlackRock's Larry Fink speaking exclusively to Bloomberg's Eric Schatzker. Now, Tom Keene, co-anchor of Bloomberg Surveillance, not CEO of Bloomberg Surveillance, though we could probably call him that, joins us now. Tom, you are counting down to that CPI data, just over 2.5 hours to go.
CPI data today really, really important as we go into a boom economy. Kaylee, huge anticipation for, it's an always popular report, but huge anticipation here. Let's look very quickly here at the chart that matters to me on CPI. There's 8, 9, 10 charts on CPI you can look at. Service sector in white, 3% has come in a little bit, call it a pandemic disinflation, and goods CPI has rocketed up to the rare occurrence where they're equal amount. This will be one of the dynamics we'll be looking at 8:30. On the show today, we're thrilled to have Adam Posen with us among many. He has a terrific essay in the New Foreign Affairs. Matt Hornbach will join us from Morgan Stanley, and Dr. Bernstein is at the White House, ready to speak.
Really excited for those conversations. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And Matt, of course, I also am watching CPI, particularly what the market reaction is going to be, because we've been sub 1.7% on the U.S. 10-year yield for about a week now, and I wonder if that equation is going to change with the print at 8:30 a.m. Eastern.
Yeah, well, I think Christian Nolting made a great point that it is very likely to change. We know that, and still it matters. That's interesting. I always think news has to be a surprise, but sometimes there are issues that are so big, even when you know they're coming, it makes a difference when they do. I'm watching Angela Merkel in just about 34 minutes time. She's going to start speaking about a new federal law she wants to pass to try and clamp down even harder on the German economy and get this COVID spike under control, Kaylee.
Yeah, Matt, I know you're so excited about that. Well, coming up in the next hour, they'll speak to Adam Posen, Peterson Institute president. Stay with us. This is Bloomberg.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Is definitely coming under control. Economic activity is actually returning to normal.
We really need to see the data in the second half. Right now, it's about projections.
What the Fed would be afraid of is that people start to behave as if the money is burning a hole.
Personally, Jay Powell and the Fed have been doing the right thing, and if anything, they will have to do more.
I don't think the Fed cares about the stock market level per se, but they do care if the stock market were to collapse.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Here comes inflation from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. It is the most anticipated CPI report, Tom, in a long time, and it comes a little bit later this morning.
It comes later this morning, and it's really the beginning of a wide set of anticipated data to calibrate, John, the size of this boom, and far more the x-axis. I can't say enough about trying to figure out how we migrate from Q2 out to say Q2 of 2022.
And
is that enough juice for you? I try to get that.
The officials, Tom, in the next 24 hours are going to be trying to shape the narrative big time. The White House is going to catch up with us a little bit later this morning. The Fed speak. Have you seen the Fed speak through today and into tomorrow? We'll hear from the chairman of the Federal Reserve, the vice chair of the Federal Reserve, the president of the New York Fed. Everybody will have their say, and I imagine they'll all be singing from the same hymn sheet, Tom. Transitory, transitory, transitory.
Yeah, it's going to be transitory. It's only going to get you so far. It's also about the real economy, and it's not just to say we're going to get 8% GDP. It's the makeup of that 8% of GDP.
Base effects, Lisa. We all know the buzzwords going into this one.
Yeah, and we're going to be drinking, so we're going to be drunk by the time it's 7 a.m. if we're going to be talking about transitory all the time. It's going to be hard to know what to do with the data. If it is higher than expected when we talk about the CPI, what's that going to mean in terms of longer-term projections? Does that curtail inflation? Because it's not good if food prices are going up really quickly and if gas prices are going up really quickly, if wages aren't following, John.
Jared Bernstein joining us a little bit later this morning. Looking forward to that conversation, Lisa. Let's get you through the price action this Tuesday morning. Good morning to you all. We're set up as follows on the S&P 500. Futures, a little bit of a bounce in the last 10 minutes or so, up 5 points now. We advance 0.13%. Into the bond market we go. Yields with a lift, approaching 170 again, 169 on 10s. Yields higher by a couple of basis points. Decent auctions in the last 24 hours. A little bit more supply to come later. Lisa will run you through that. Euro dollar just a break of 119, a mild one, 118.95 on euro dollar. We're softer there, Lisa, by about 1/10%.
Yeah, a lot of uncertainty around the CPI print that we're going to be getting in about 90 minutes time, or no, Actually, it's at 8:30, about 2 hours and a half away. Gosh,
Nailed that, Lisa.
Wow,
Nailed
I'm trying. Thanks a lot, Tom. I guess that's because we say transitory so many times before 6 a.m. That I'm questioning my own words. CPI year over year expected to be 2.5% versus the 1.7% last time. Again, good inflation versus bad inflation. If prices that we do for the staples, that we pay for the staples, go up too quickly, is this problematic for a global economy that is depending on the U.S. to be the engine? Then today we're also going to get the monthly OPEC report on oil demand and supply. Very interesting to see how much mobility is picking up in the U.S. and Europe. And then, John, to that point that you're talking about, 1 p.m. we're going to be getting that $24 billion sale of 30-year notes. Again, yesterday's 10-year auction went pretty well. 30-year auction might be hairier considering the fact that it's so uncertain, the longer-term inflation picture. But really, they're all okay. It's just the 7-year that's been problematic, John, over the past few auctions.
10s were decent, 30s maybe more the same a little bit later, but we need to sit on this just for a second, Tom. There's a reason I think the White House is going to join us a little bit later, and we can talk to Jared Bernstein about this. They need to make sure that this narrative doesn't get away from them around the inflation story, because there's still a whole lot more work to do down in Washington, D.C., and the supply story on the Treasury side is a key part of that.
Well, good. Yeah, the Treasury yield is where it is, and it's come back a little bit. What, I've got back 4 basis points, I'll say, John, over the last 24 hours. I don't know where the range is to break out, but that's going to be based off what core CPI does. I can't emphasize enough, John, how the academic literature of the last month or 2 months has been a reaffirmation of the sanctity of core inflation, ex-energy, ex-housing, with all the oddities there. So I'm going to look at core inflation that will fold into the rate market and fold into the dialogue you talk about.
Just a final one from me, Tom. Do you think we'd be having this conversation in the way we're having this conversation if Larry Summers hadn't written that op-ed several weeks back, a couple of months ago?
Oh, that's political at the margin. Yes, it's germane, but I think that there's a set of people analyzing constructively what's going on with the majority Democrat Washington, and part of it is what Mr. Summers said.
It has been the debate of the last 2 months. Are we about to see sustainable inflation in the United States of America? And let's be clear, this is what the Federal Reserve has wanted for a long time. The idea that we're talking about a 2.5% inflation print 12 months after turning the economy off, turning the global economy off, is quite remarkable in and of itself. Adam Posen joins us now, Peterson Institute president. Adam, let's just start there. Set the stage for us for this inflation print in about 2 hours and 30 minutes. What are you looking for, sir?
Thanks for having me, Jonathan. I think I'm looking for a lot of fuss signifying nothing, because this inflation print is really about technical things like base effects. Just when you bounce back from the kind of shutdown we had, you're just going to end up with readings of inflation. You're also going to have these short-term bottlenecks. As you and Lisa were joking about the word transitory, the transitory issue is really going to come in 2022. That's where the real Fed debate is. That's where the focus should be. And frankly, that's where Jared Bernstein, representing the White House, should be talking. The fact that there's going to be some inflation for the next few months showing up in non-core, which are headline, which Tom points out, is not going to worry. You're right that the Fed is acting like they're worried. They're trying to get ahead of this, but people shouldn't worry.
The inflation study that we have is partitioned, Adam Posen, into services and goods inflation. Is that a correct study?
It's a correct first cut, but it's not a sufficient cut, Tom. As you know, Jim Stock from Harvard and various people in the Federal Reserve System have been looking at breakdowns of inflation into bigger components, smaller components, but still significant ones. I think that the 2 key components to be looking at are, as Jonathan mentioned, wages, because that's ultimately what we care about, both in the sense of its own terms and in the sense that that's the one thing that does lead to future headline inflation. And the other one, which I've been emphasizing for the last couple of weeks publicly, is healthcare inflation. That, healthcare is 18, 19, 20% of the economy. It's one of the services where there is genuinely pent-up demand, people who put off procedures they considered elective amidst the pandemic, and which there will be a shortage of available supply. So either it'll get rationed by people waiting a lot longer, or prices will rise. So to me, it's wages and healthcare are the subcomponents you really want to focus on.
When do we know whether the wage inflation that we're starting to hear about with some labor shortages, whether it's transitory as well, or whether that has longer lasting legs?
It's a really good question, Lisa, and there's no simple answer because wages, as we know, have been getting compressed for a couple of decades now. I don't mean there's been no growth, but the share of GDP growth going to wages has been way down versus preceding decades. So there's some way you could have wages growth without it necessarily turning into inflation if basically workers get to take back some of the money that capital has been holding on to. And that's hard for the Fed to discern the difference, both because you don't get the data till later and because it looks very political. So there's no easy call on that, I'm afraid.
Dr. Posen, we like to get out in front of the zeitgeist. Sometimes we succeed, sometimes we fail. Right now I'm going to succeed and anticipate your essay in Foreign Affairs magazine. Folks, this will be out pretty much any day here for the May issue. And you speak of the nostalgia all of us have. John Farrow's incredibly nostalgic. Lisa Abramowitz just bathes in nostalgia. And we're all doing it about trying to find an America, trying to find an Atlantic policy from another time and place. What does it mean for our viewers and our listeners as we wax nostalgic?
Thank you for citing my forthcoming article, Tom, in Foreign Affairs. What I mean when I talk about the price of nostalgia is this fixation that American politicians have on heavy metal, on men bashing machines, running tough fisheries, all these sorts of visuals that you see on the Bruce Springsteen Jeep commercials about what is the important good way to have a good middle-class job. And it's nostalgia because it's misplaced, because those kinds of jobs, there's only so many of those. Even in the best of times, you're only going to be able to add a couple percent to the workforce doing that, and it's not going to help the rest of the economy. And it just further ignores, frankly, women and people of color who are predominantly in low-wage services jobs among the, and whereas the old manufacturing sector part of the nostalgia is it's overwhelmingly white men. And so this just further reinforces the sense of frustration and privilege. And the other point just to make is that it's not going to work. I mean, there are people who think you do this, you fixate on manufacturing because you'll buy off the fascists, but it's not going to buy them off because all it's going to do is reinforce their sense of special status. So I'm urging the Biden administration and people to get past the nostalgia and worry about bringing up jobs for everybody.
It's an important essay, Adam. We appreciate your time, sir, as always. Adam Posen, Peterson Institute president. Turning to the data of this morning, Adam, the first in a series of guests, I'm sure, to drain the drama from the inflation print that comes out in about 2 hours and 30 minutes' time. And let's talk about it, Tom. 2.5% is the median estimate year-on-year for CPI. Core, 1.5%. And let's have a little bit of context perspective here. We turned the global economy off this time last year. We're switching it back on in the United States and firing it up with a ton of stimulus as well. And yet still, the estimate is only, and I say only, 2.5% on CPI. This is what the Fed's been looking for a long, long time, and they've needed the monster of all base effects, plus a ton of fiscal stimulus as we reopen to get anything in and around 2.5%.
Well, and you got to sustain there. It's so important to say that they got an overshoot. They can take the pendulum, John, the pendulum of inflation and bring it nicely above 2%, however you measure it. But then it's got to stay there and sustain before you get to the fear. That's a lot of data points we need. I would really want to point out, John, that not only is inflation a big deal today, but retail sales in 2 days is probably of equal weight.
Thursday, that number's said to be huge. And I also think we have to draw a distinction between the conversation happening amongst economists, where there is immense conviction around the T story, the transitory story. And for market participants who have been burnt so much over the last 12 months or so, Lisa, the word I keep hearing is humility. Be humble. Be humble about what's about to happen in the next 12 months, because we don't know.
Without a doubt, and the uncertainty is massive, including that $1.8 trillion cash pile of extra savings that people say might go into the economy or might not.
Everybody has a take on this inflation print. Everybody, including the White House. Jared Bernstein, member of the White House Council of Economic Advisors, joining us a little bit later this morning, I believe 7:45 Eastern Time. Your equity market looks like this, up 2 points on the S&P, advancing not even 1/10 of 1%.